It's a powerful engine, and it's wonderful to have the honor to lead it.
Brian, always a pleasure to catch up. Congrats on the decade next week, and thanks so much for joining us. Brian Moynihan, the Chairman and CEO of Bank of America. Guys, I'll send it back to you.
Well, thanks very much. As we go to break, check out shares at GameStop, down almost 20%. Surprise third quarter loss of 49 versus expected 11. Comps down 23. They cut their profit forecast for the full year. Amazingly, this only takes you back to about 2 months ago. Squawk Alley's back in a moment.
This is the investing book everyone is talking about. It's called
Rainy, 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 rainy.
Sergey, why are you in such good mood?
It's raining.
And?
Rain means we take meal pups to cinema. And cinema means they'll be entertained.
And entertained means they're also quiet for a couple of hours. Oh, let's go. Enjoy 2-for-1 cinema tickets for Meerkat movies when you buy through Compare the Market.
Qualifying purchases Tuesdays or Wednesdays. Participating cinemas. 2 standard tickets only. Cheapest ticket free. T's and C's apply.
Hey, NFL fan, can't watch the game? Can't be there? No biggie. With your TuneIn Premium membership, you already have an all-access pass to every team and every game in the league. Amazing, right?
Steps up, floats it towards, at the goal line, it's intercepted!
Listen live as the action unfolds, or on demand when you can. Anytime, anywhere, all season long.
Right side, it is caught, it is in for the right side for the touchdown to Keenan.
Search NFL today. Hey, NFL fan, can't watch the game? Can't be there? No biggie. With your TuneIn Premium membership, you already have an all-access pass to every team and every game in the league. Amazing, right?
Steps up, floats it towards, at the goal line, it's intercepted!
Listen live as the action unfolds, or on demand when you can. Anytime, anywhere, all season long.
Right side, it is caught, it is in for the right side for the touchdown to Keenan.
Search NFL today.
Hockey fans, the 2019-20 NHL season is here.
And tucks it home!
And with this team, it's really fun to be a part of a team like that.
And you can hear the action live on TuneIn Premium. From regular season action to the All-Star Game and through the Stanley Cup in June. Hear the home and away call for every game, for every team live. At home or on the go, never miss a game with the NHL on TuneIn Premium.
Upgrade today. Want to know a quick, easy way to see if your favorite podcasts have a new episode available? Just go to the home screen on your TuneIn app and see the latest editions under the Your New Episode section. Happy listening.
Hey, can't watch the big NBA game because your life's just too busy? I've got some news for you. TuneIn Premium is the answer to all your problems. Hear every home and away game live or on demand everywhere you go. Just search NBA to listen.
Want TuneIn to remind you when the big NFL game is about to get underway? Be sure notifications are allowed on your phone and search NFL on the TuneIn app. Find the game you want to hear under events and tap Notify Me. We'll let you know exactly when it's time to listen in for kickoff.
Welcome back to Squawk Alley. European markets just closing. Seema Modi joins us now to tell us how they look. Seema.
And John, 2 big events tomorrow, the ECB policy decision and the UK election. Ahead of that, European markets are moving to the upside here. But drawing your attention to shares of Inditex, this is the largest clothing retailer in Europe, beating street expectations. In fact, it saw profits jump 12%. The company says the rollout of a new technology, which includes RFID chips, has made it more efficient in managing inventory at its big brands, which includes fast fashion retailer Zara and menswear Massimo Dutti. The CEO of the company says Inditex has also become more strategic in where it opens retail stores, sticking to big cities versus smaller ones. Now, the strong earnings report comes as its key rival H&M continues to struggle with destocking and high inventory. Now, tomorrow, Christine Lagarde makes her debut as ECB president. No policy change is expected at the meeting, but economists will be keeping a close eye on her Eurozone forecast for 2020 and whether she plans to continue where former ECB President Mario Draghi left off. She has already been calling on more fiscal spending by governments, a message that has been echoed by Draghi as well. Leslie, back to you.
All right, Seema, from Europe to Atlanta, Georgia, that's where our Frank Holland is with 2 special guests. Hey, Frank.
Hey, good morning, Leslie. We're here talking about the partnership between UPS and CVS. It's designed to help the carrier handle the increased volume of packages during the holiday season and also increase profitability year-round. 4,600 of these drugstore locations are now a place where people can pick up and drop off their packages. It's still early in the partnership. It started in July, and it's a small sample size, but CVS says it's already helped to increase the sales of its retail products. The question now is, will this tie-up between UPS and CVS help it compete against its legacy rivals of FedEx and Walgreens, as well as the potential disruption of Amazon? And to answer that question, we're now joined by the CEO of UPS, David Abney, and the CEO of CVS, Larry Merlot. Gentlemen, thank you for joining us.
Great to be here, Frank.
Absolutely. So we're going to start off. You guys were actually just here touring this facility the first time you've been in one of these together. What did you see, and how do you see this having potential to increase profits for both of your businesses?
Well, Larry and I met a couple months ago, and he told me about the concept. Our companies have had a long-standing relationship. In fact, all the way back to 1922. That's how far our relationship goes back. Not mine and Larry's personally. But, and so we talk a lot about what we can do for each other and how we can make our companies stronger working together. And he explained this concept. And certainly wanted to see it firsthand, wanted to hear more about it. It's been a very productive morning, that's for sure.
And Frank, it's really about meeting the unmet needs for our consumers. And this is one of our concept stores that we call the Health Hub. And, it's about access, convenience, and it's more of a health destination in terms of helping, consumers get more engaged around their health and as a result to create more healthier outcomes.
Great. So obviously you two enjoy each other's company, but does it make sense from a business aspect? Where do you see the benefits for your individual businesses?
Well, Frank, you think about the fact that we're in 10,000 communities across the country. Today, about 70% of the U.S. population lives within 3 to 4 miles of a CVS. So we listen to our customers all the time in terms of, what does convenience, what does access, what is their unmet need to meet their day-to-day challenges? And the partnership that we have, does that very thing. It makes access to products and access to care more convenient.
And David, you're also moving to 7-day-a-week delivery. Does this help you with people dropping off and picking up here?
This is a big advantage for us. And healthcare is certainly one of our strategic imperatives. It's one that we're investing in heavily. And that's why this relationship is so important. But the access point process where UPS customers can come in and pick up or drop off packages as they're conducting their day-to-day life, and the convenience of the locations along with the convenience of UPS, just been a good partnership for us.
Excellent. Well, your legacy competitors, FedEx and Walgreens, they also have a very similar partnership. It appears to be very similar on the surface level. What would you say the differences are between your two approaches?
Well, David, we have a tremendous amount of flexibility in terms of, My Access allows you to, direct activity to the store that's closest to you. We think customers absolutely love that's the feedback that we're getting.
What about for you, David?
What's important to us is to make sure that we take the strengths of both companies and we look to where we can make it a better experience for our customers. If we focus in that regard, then we will have differentiation, and it's the customer that will vote.
Right. Most companies are fighting off disruption. In your case, you're actually fighting off disruption from the same company, Amazon. In your case, Amazon's projected next year, according to ShipMatrix, a company I know that you're familiar with, to double the amount it self-delivers. And on your end, at Loop Capital, they just put out a note just a few days ago saying that they see Amazon Pharmacy having the potential to take 8% of the market within the next 5 years. Does this partnership help you fight against that level of disruption?
Well, Frank, again, as we've been talking, it's, how do we meet the unmet needs of consumers? And, I think from the relationship that we have, innovation is in both of our companies' DNA, and we've got a great partnership here. And, look, we work very hard to make sure we don't leave any white space for disruption. So, as you think about tremendous respect for Amazon in terms of what they've accomplished, and, whether you're talking about PillPack, we have those same products and services. And you sit here and say, who should be worried about, the innovation? I would say it's probably the independent pharmacy operator, perhaps the regional grocers, that aren't making the investments to meet those customer demands.
And I think that the key for us is to embrace disruption and the fact that the market's changing. Our customers are changing. E-commerce is growing. So we can't look for ways to fight that off. We have to embrace it. And when you think about e-commerce, you can think about large retailers, but there's a lot more to e-commerce than a large retailer. We do business with 90% of the major retailers in the world, and that is a big part of e-commerce. And then just hundreds of thousands of small and mid-sized customers. So our focus is on all customer bases and not just one particular e-tailer or one particular group, but it's across the entire base.
And we have a question actually for one of our anchors right now. We're going to toss things back to them. And gentlemen, if you just look in the camera.
Larry, John Fort in New York. I'm wondering if this becomes the new normal, how much are you going to have to change store design and employee training to have handling customers' property as part of what you do?
Yeah, John, we started our Health Hub concept in Houston, Texas earlier this year. The feedback that we've gotten from the customers that we serve there has been terrific, and it's resulted in a more rapid rollout. We're here in Atlanta. We're also expanding this concept as we speak in Philadelphia, Tampa, with plans for 1,500 Health Hub stores by the end of 2021. And there is a different service model that goes beyond the role of the pharmacist, the role of the nurse practitioner in a minute clinic. It includes services that we call a care concierge that is really helping consumers, find whether it's a product, a service, and actually, help them on a path to better health. So we're off to a wonderful start, and, it is, satisfying the unmet needs for consumer health.
One last question, gentlemen. FedEx and Walgreens are also partnering on drone delivery. Can we talk about when you see that being commercially feasible, profitable? Is that a big part of your strategy going forward?
I can start that question. We are the first company, UPS, first company that got the full FAA Part 135 certification. And we are the only company in our industry that has a business that we're making commercial deliveries on a day-to-day basis. In fact, we already have 1,900 of these commercial deliveries that we have made. Now, we're also working together on some very important tests that when the regulations are developed, that we believe there's a lot of expansion opportunities, and we will be very much at the lead of that. But this is not a future tense thing like a lot of companies are talking about what they're going to do. We're actually doing this today with those 1,900 commercial deliveries.
And Larry, do you see this as an important piece of your business going forward, the ability to drone deliver prescriptions and maybe retail items?
Well, Frank, I think it goes back to this notion of, how does the consumer define access and convenience as we go forward? And, we see the opportunity that the drone has in terms of meeting customers' needs.
Excellent. We're going to have to leave the conversation there. Larry Merlot, the CEO of CVS, David Abney, the CEO of UPS. Gentlemen, thanks for joining us and tossing things back to you.
Thank you.
All right, Frank, thanks very much. Our Frank Holland. More Squawk Alley continues in just a few moments.
Hi, I'm Barry Sloan with NewTek, your business solutions company.
Smoked salmon for breakfast? Well, it is Christmas. At Asda, our extra special gin, juniper and lemon smoked salmon is just £4 for a 120-gram pack. Or for only £6, get a 200-gram pack of our extra special smoked salmon. Asda, let's make Christmas extra special. Selected stores subject to availability.
On 3, our unlimited data is actually unlimited. Like for reals. None of this, we're so unlimited, but you can't watch your fave Christmas film endlessly, or dead scroll inspo for tree decorations until 4 in the morning. We wouldn't do that to you.
We have no speed limits, no data caps, and you'll be 5G ready at no extra cost.
Ho, ho, ho.
Switch to 3, in-store or online. See 3.co.uk/unlimited-data.
Dear Dad, Merry Christmas. Thank you for always doing everything you could to make this time of year special for us. No one has a Christmas jumper collection quite like yours. Your festive spirit...
Gingerbread latte with 2 shots and nutmeg whipped cream for Joe.
I hope it snows. I know how you love a white Christmas. All my love, Joe. Heartfelt can happen anywhere with moonpig.com. Download the app and get 20% off when you buy a card and gift this Christmas. Use code Heartfelt20. Exclusions apply.
Cutting for the net. Scores! On the goal line, Marchand scores!
Hockey fans, the 2019-20 NHL season is here.
And tucks it home!
And with this team, it's really fun to be a part of a team like that.
You can hear the action live on TuneIn Premium. From regular season action to the All-Star Game and through the Stanley Cup in June. Hear the home and away call for every game, for every team live. At home or on the go, never miss a game with the NHL on TuneIn Premium.
Upgrade today.
Far wing, elevates, triple bucket.
The roar of the crowd. The shot clock ticks down. Will the ball go in? The suspense is pure torture, but you wouldn't miss this for the world. And the replays just don't cut
To
it.
the sideline, the man fleet for 3.
TuneIn Premium brings you every minute of the NBA season streaming live, so you can be there when it matters most. Hear it now, hear it live on TuneIn.
Fake in the lane, turnaround jumper from 8 feet is good on the
Search
right block.
NBA Today to start listening.
Be better informed, be better prepared. The Better Network is on TuneIn. This is Brent Musburger. Search BETR and start hanging out with me and my guys in the desert weekday afternoons. The Better Network is now on TuneIn.
Let's get over to the CME now and Rick Santelli for the Santelli Exchange. Hey, Rick.
Good morning. You know, the year-end funding in its totality has vernacular that everybody uses that's in the financial markets. It's called the turn, the year-end turn. It's when institutions, large and small, traders, customers, large and small, make sure they have all the different financing lined up and taken care of as we go into holiday mode at the end of the year and come out on the new side of a new year. And this year has some particularly interesting issues on how the turn will turn out. It ranges from don't worry, because usually when you expect or are ready for problematic issues to arise, they never do, versus the notion that if you don't see something coming, the light at the end of the tunnel may be a train coming the other way. But all those are just fancy word games. Let's get down to what really is going on. Okay, we have restricted financial plumbing. Okay, what does that mean? That means all the various systems used to direct, aid, and facilitate the borrowing and lending of securities, the apparatus that makes that work has less accessibility and output than the growth of everything that needs to run through that system, and the fulcrum of that mismatch began after the credit crisis. You know, Rahm Emanuel, the ex-mayor of Chicago, once inferred, you never let a good crisis go to waste, meaning that when we are in crisis times, people that lead usually have much more latitude to do things they could never do under normal conditions. And boy, that is true. Whether you look at the Volcker rule or all the issues after the crisis, we understand why they occurred, but they're going to have to change. At the end of the day, the cost associated with the intermediation of what goes on to finance securities has been taken over by the Fed. And at some point, they're going to have to address the real problem. And the real problem is they're going to have to tweak regulations to find a way to match the growth in financing of securities with the growth of issuing securities. Carl, back to you.
One more thing we're looking for answers on, Rick. Thank you, Rick Santelli. When we come back, just how popular is Disney Plus? We got some exclusive data that might give you a clue when Squawk Alley comes back.
In a changing environment.
Hey, NFL fan, can't watch the game? Can't be there? No biggie. With your TuneIn Premium membership, you already have an all-access pass to every team and every game in the league. Amazing, right?
Steps up, floats it towards, at the goal line, it's intercepted!
Listen live as the action unfolds or on demand when you can. Anytime, anywhere, all season long.
Towards right side, it is caught, it is in for the right side for the touchdown.
Search NFL today.
Did you know your favorite radio stations are in your pocket? Yes, the TuneIn app lets you listen to the same radio stations you pick up on your home or car radio anywhere you want. To see all the stations broadcasting in your area, find the local radio section on the home screen. Keep it local with TuneIn.
When you're not listening to your team, take it to the end zone, the rim, or the net. Keep up with the biggest moments in sports by following TuneIn on social media.
Block, Cook into the end zone for the touchdown.
From reminders of the live top games to tips of the best sports stations and podcasts.
Welcome to Undisputed. We are live from Los Angeles. I'm Jenny Taft here with Skip Bayless.
Follow at TuneIn on Facebook, Twitter, and Instagram to get the most out of TuneIn.
This is not a commercial. This is a reminder. With TuneIn Premium, you could be listening to more music commercial-free. Get over 45 commercial-free music stations. Visit TuneIn.com/premium to upgrade.
The swagger of a perfect dunk. The rush of a three made from all the way downtown. The adrenaline surge of great defense. Can you feel the goosebumps yet? There's nothing like live NBA and nothing like listening live on TuneIn.
Giannis down the lane to the rim, throwing right corner three. Another
TuneIn Premium brings you every minute of the NBA season so you can be there when it matters most. Never miss the action as it happens. Hear the ball you love. Hear it live on TuneIn. Search NBA today to start listening.
Introducing a new podcast, ESPN Daily. When you want to go beyond your feed, when you want to get inside the score, when you want to get behind the highlight, there's ESPN Daily. Go deeper into the stories of the moment. Get the exclusive access and insider perspective that only ESPN can give you. ESPN Daily, hosted by me, Mina Kimes. Listen and favorite ESPN Daily on TuneIn.
I'm Scott Wapner. The Halftime Report is live today on the trading floor of Double Line Capital in downtown Los Angeles with the bond king, Jeffrey Gundlach. We'll get his outlook on interest rates and the Fed on this Fed Day. We'll talk about where the money will be made in fixed income and beyond in 2020. And, of course, the man who correctly predicted Donald Trump's win in 2016 weighs in on the 2020 election as well. We'll do it all at the top of the hour. Carl, we are just minutes away now from this exclusive interview. Back to you.
All right, can't wait, Scott. Thanks. On the Amazon front this morning, security researchers discovering vulnerabilities in smartwatches for children sold on the website, reportedly making it possible for strangers to override parental controls and track your kids. Rapid7, a cybersecurity firm, purchased 3 smartwatches randomly on Amazon, costing from $20 to $35, all models offering location tracking, messaging, and chat features. All models were manufactured in China, sharing nearly identical hardware and software. The multitude of product offering has opened Amazon to all kinds of liabilities here regarding press coverage.
Yeah, this is the worst. The kids, tech, actual bad guys being able to track your kids. My personal philosophy is, how about the old days? Like in the 80s when I grew up, when it was really dangerous, but you couldn't track kids. You had to teach them street smarts, use a payphone, figure out how to fend for yourself. That's still valuable. Even the tech that you try to use to protect your kids can backfire.
But I think the question is, how much accountability should Amazon have for the products that are sold on their site? Because you've had issues with counterfeit before. You've had issues with mislabeling of products that seem to be cleared by the FDA and other regulatory bodies, turn out not to be so. This is just another example of that. Should Amazon be forced to take responsibility for those products?
Yep.
Or is it one of those things that it's a platform model, they can't be held liable?
We're just a platform, John.
We're just a platform, we can't control. There's, billions of items sold on our site.
If you try to sell me anything for protecting my kids, do not go, I didn't know it was actually going to open them up to danger. No, absolutely not. Absolutely not. Well, we've got some exclusive data on the popularity of Disney Plus. Take a little left turn here. Julia Borston has those numbers for us. Julia.
Hi, John. That's right. Today, Apptopia reporting that Disney Plus has been downloaded to mobile devices 22 million times. Now, Disney Plus has averaged 9.5 million daily active mobile users. It's ranked number 1 in Apple and Google's app stores every day since the app launched. And these numbers only measure mobile use. They do not measure use on smart TVs or streaming devices such as Roku and Apple TV. And we don't know how many of these users are using a 7-day free trial or who are among the Verizon Wireless Unlimited subscribers who get 1 year free of Disney+. But Apptopia reports that Disney has brought in $20 million in revenue from the app, which is a combination of revenue from monthly fees as well as people who have signed up for year-long annual contracts. Now, Apptopia says that Disney Plus's early success does not seem to be hurting mobile downloads or traffic to other streaming services, but Disney Plus is boosting new installations of Hulu and ESPN, which are bundled with Disney Plus at a discount, as well as streaming tool Roku. Now, Disney Plus's user base is still dramatically smaller than Netflix. Netflix, of course, reported over 60 million U.S. subscribers as of its last quarterly report. But it is notable that on a per-user basis, Apptopia reports that Disney had nearly 6% longer average session times than Netflix and nearly 8% longer session times than users of Amazon Prime Video on their mobile devices. Now, Disney declined to comment on Apptopia's data. We'll have to wait to hear its official numbers in its fourth quarter earnings, but there are plenty of signs of demand for this Disney Plus streaming service. Google's annual search trends report says that Disney Plus was the top trending search in 2019. Guys, back over to you.
All right, Julius, plenty of momentum just in that first month. Thank you. When we come back, why Elon Musk says he's come full circle. Squawk Alley is back after this quick break. Don't go away.
Am I ready to retire?
Am I ready to retire?
At Asda, packs of beer are just £12 each, including 24 bottles of Budweiser, 18 cans of Stella, or 12 bottles of Birra Moretti. Looks like you're hosting this year. Asda, let's make Christmas extra special. Selected stores online subject to availability. Budweiser 300ml, Stella 440ml, Moretti 330ml. Exclude Scotland drinkaware.
Christmas. A time for celebrating, unwrapping, and unwinding. Capture every moment with an epic iPhone 6S with a 12-megapixel camera. Now only $12.99 a month from Tesco Mobile, saving you £72. It's just one of the ways we're celebrating 100 years of great value. Go in store or search Tesco Mobile. Tesco Mobile. Every little helps.
Saving £2 per month over 36 months was £14.99. 36-month credit and rolling monthly usage agreements required. Subject to status. Terms apply. See tescomobile.com/terms.
Christmas. A time for celebrating, unwrapping, and unwinding. Capture every moment with an epic iPhone 6S with a 12-megapixel camera. Now only $12.99 a month from Tesco Mobile, saving you £72. It's just one of the ways we're celebrating 100 years of great value. Go in store or search Tesco Mobile. Tesco Mobile. Every little helps.
Saving £2 per month over 36 months was £14.99. 36-month credit and rolling monthly usage agreements required. Subject to status. Terms apply. See tescomobile.com/terms.
Hey, NFL fan, can't watch the game? Can't be there? No biggie. With your TuneIn Premium membership, you already have an all-access pass to every team and every game in the league. Amazing, right?
Steps up, floats it towards, at the goal line, it's intercepted!
Listen live as the action unfolds or on demand when you can. Anytime, anywhere, all season long.
Right side, it is caught. It is in for the right side for the touchdown. Again.
Search NFL today.
Finally another commercial, said no one ever. Visit tunein.com/premium to upgrade now and get over 45 commercial-free music stations.
2 hours till the Fed decision and the presser. Markets in a tight range right now. Squawk Alley's back in 3.
Apps are used everywhere except work.
The Better Network is now on TuneIn. This is Brent Musburger. Search the Better Network. That's the BETR network. And then let us get you better prepared to better enjoy the day in sports. The NFL, college football, basketball, hockey, baseball. Sharpen your edge. The Better Network is now on TuneIn. Be better informed. Be better prepared. Search the Better Network. That's BETR.
Hey, NFL fan, can't watch the game? Can't be there? No biggie.
that.
With your TuneIn Premium membership, you already have an all-access pass to every team and every game in the league. Amazing, right?
Steps up, floats it towards, at the goal line, it's intercepted!
Listen live as the action unfolds or on demand when you can. Anytime, anywhere, all season long.
Right side, it is caught. It is in for the right side for the touchdown to Keenan.
Search NFL today.
Far wing, elevates, triple bucket.
The war of the crowd. The shot clock ticks down. Will the ball go in? The suspense is pure torture, but you wouldn't miss this for the world. And the replays just don't cut
To the
it.
sideline, the man Fleet for three.
TuneIn Premium brings you every minute of the NBA season streaming live, so you can be there when it matters most. Hear it now, hear it live on TuneIn.
Fake in the lane, turnaround jumper from 8 feet is good on the
Search
right block.
NBA today to start listening.
Want to know a quick, easy way to see if your favorite podcasts have a new episode available? Just go to the home screen on your TuneIn app and see the latest editions under the Your New Episode section. Happy listening.
Cutting for the net, scores! On the goal line, Marshawn scores!
Hockey fans, the 2019-20 NHL season is here.
And tucks it home!
And with this team, it's really fun to be a part of a team like that.
And you can hear the action live on TuneIn Premium. From regular season action to the All-Star Game and through the Stanley Cup in June. Hear the home and away call for every game, for every team live. At home or on the go, never miss a game with the NHL on TuneIn Premium.
Upgrade today.
Hey, tune-in listeners, Steve Kornacki here from NBC News. I want to tell you about a podcast I'm hosting called Article 2, Inside Impeachment. It's dedicated to bringing you the latest developments on the impeachment inquiry into President Trump. Every Monday, Wednesday, and Friday, I talk to NBC News reporters who are closest to the story to break down what's new, what matters, and what it means for the 2020 election. Search and favorite Article 2, Inside Impeachment on TuneIn.
Welcome back to Squawk Alley. We're looking at a picture of a 24-year-old Elon Musk fixing the window of a car. Here he was about 9 months away from co-founding Tesla. His mom, May Musk, tweeted that picture, to which Elon replied, "Couldn't afford to pay for repairs, so I fixed almost everything on that car from parts in the junkyard." Ironically, that's me replacing broken side window glass. The circle is complete. LOL. It's nice that he can be reflective like that.
It is. Somehow he looks 45 in that picture in an oversized shirt. And the circle is complete. Similar to that quote from Darth Vader, the circle is now complete.
Fulfill your destiny.
Now I am the master. So bring it back to that Disney Plus. Wrapping it all around, tying the show all together.
I think for that circle to be complete, we need a side-by-side of him fixing the Cybertruck, though.
Yes.
You know, can he still fix windows now that he's a billionaire?
This is all leading up to. Guys, between Boeing, Home Depot's guidance, and oil, you would think that markets might be down more than they are. Obviously, no, we have big news coming in the next couple of hours with the Fed decision and then Powell's presser at 2:30. For now, though, Dow down 50, and of course the judge with Gunlack in LA. A lot to be said with Gunlack in the next hour. So let's get to the half.
Carl, thanks so much. Welcome to the Halftime Report, live from the headquarters of Double Line Capital in downtown Los Angeles. We are joined today for the hour by the firm's founder and chief executive officer, Jeffrey Gundlach. The markets, the Fed, the president, and all points in between on our menu over the next 60 minutes. We now welcome in Jeffrey Gundlach. Thank you for having us once again.
Yeah, welcome, Scott. Welcome to Double Line again.
Yeah, it's good to be here on this Fed Day, the final Fed day of the year.
Yep.
What do you expect today?
I think I saw on CNBC yesterday there was a survey, and the result was unanimous. 100% said the Fed isn't going to do anything, and I have nothing to add to that because that seems absolutely positively correct. The Fed is going to keep rates unchanged and probably have a message that they are kind of encouraging inflation to go higher. One of the most important statements that I think has gotten less play than it should is Jay Powell said in late October. He said that we would have to see a significant rise in inflation that is persistent to even consider raising interest rates to fight inflation. So the Fed wants inflation to be higher, actually, and they've contextualized this by saying, well, 2% was our target for many, many years, and we fell short. So now we need to kind of fill the gap, which makes no sense to me whatsoever. I think it's cover for wanting interest rates to basically be below the inflation rate, which seems to be the game plan for central banks in developed countries really around the world. And so now we have the 10-year Treasury yield is below the inflation rate. The CPI is up at 2%. The core CPI is up higher than 2%. And yet the interest rates are being kept below that. So Fed knows that we have a debt problem in the United States and that the way to push it out, the day of reckoning out into the future, is to have interest rates below the inflation rate, which has been accomplished now by the Fed.
I want to talk to you about Jay Powell. You said the other day that you'd give him a C- if you were grading him, and you likened him to a losing NFL football coach. How's that fair?
Well, because Jay Powell 12 months ago had a framework about what his outlook was for 2019, a basic framework about viewing the world. And that framework was quantitative tightening on autopilot, regardless of economic data, and successive interest rate increases during 2019. And 3 weeks later, it was exactly the opposite. So it's difficult to give him a lot of credibility in the messaging because of the U-turn that was taken. And instead of raising rates successively in 2019, we've cut rates 3 times in 2019. So a very different playing field for 2019 than what we expected. I think the one reason that I'd give Jay Powell a C- and not a D is that he has said, and I'm not sure we can believe him because we couldn't believe what he said last December, he has said that to fight the next recession, he does not believe negative interest rates are a good idea in the United States. And I applaud that as loudly as I possibly can, because I think negative interest rates in the United States would really be a problem for the global financial system. He has said he will do large-scale asset purchases to fight the next recession, which means, obviously, a quantitative easing program. So what we are looking at is an environment where the next recession, I believe, left alone to market forces, long-term interest rates would probably rise. But Jay Powell, I believe, has told us, if we can believe him, because he changed his mind so quickly after his December statements, but he's told us that he will control long-term interest rates to fight the next recession through quantitative easing.
What's wrong if he simply realized, and the Fed realized, that maybe they made a mistake by raising rates last December?
Nothing's wrong with realizing they made a mistake.
The playing field, using your language, changed, perhaps. The trade war, there are tariffs.
Actually,
he's had to manage his way through all of that.
Yes, I suppose. You're being kind of generous. I mean, when he did the quantitative tightening autopilot statement and the successive interest rate increases, the risk asset markets were already having trouble. It wasn't like that suddenly him saying that led to the decline of over 20% in the stock market and the closure of the junk bond market, where there were 2 months where you couldn't even float a new issue junk bond in the fourth quarter of 2018 because the market was closed. This was all because of what the Fed was doing. And yet it was when the market finally flushed out down in late December where the apology tour came out. So I think that what happened was the Fed thought they had a framework that was working. The markets threw a temper tantrum about it, and they were forced then to go back to basically the Fed model that we've had for quite a few years now, which is following the market, rather than, I mean, the great Paul Volcker just passed away this week at age 92. He was the one that really had control over what the interest rates were and wasn't just listening to the market. And I wish that if the Federal Reserve has a purpose, it should be to have an outlook and follow it regardless of what the market does. And instead, Jay Powell capitulated and went along with what the bond market has said. And now the bond market's completely in sync with the Fed. I mean, you have Fed funds rates, the same basically as the 2-year Treasury, which is the 5-year Treasury, which means that the Fed is now comfortably on hold. But what Jay Powell has done is he raised rates 4 times and in 2018, then cut rates 3 times in 2019. We basically have gone nowhere. We've just put ourselves on kind of a wild ride, which I believe was unnecessary.
Are you against the concept and the idea of an insurance policy? Because that's what it was. It was taking out an insurance policy unless things got bad because of the trade war and other issues, be it geopolitical or otherwise. You can throw Brexit into that stew and the uncertainty of knowing where all of that was going to play out. What's wrong with an insurance policy?
why did you raise rates 4 times in the first place? Is my reaction to that. There's nothing wrong with adjusting policy, and you can call it insurance policy, you can call it mid-cycle adjustment if you want to. But it doesn't seem to me that there's much chance of the Fed really following through on this mid-cycle adjustment concept, because that would mean that we're going to raise rates again. Yet Jay Powell in October said to raise rates, we need a substantial increase in inflation that is persistent. So even if inflation goes up, what they're telling you is there's no intention of raising interest rates unless the dynamics change pretty remarkably. So all we did was raise rates 4 times just to cut them 3 times. We should have just left them alone the whole time, is my opinion.
Do you think he should be replaced? I mean, he's taken fire all year long from the president.
No, I don't think he's any different than what you would replace him with. I think the Federal Reserve has turned into a body that's essentially following the market. And now the bond market is saying there's no purpose in raising rates, so they're not going to raise rates. There's no purpose in cutting rates. And so we're probably going to be on hold for quite some time. The bond market says that will probably be unchanged interest rates until maybe the 3rd quarter of next year. And that to me is what's motivating the Fed.
Labor market's pretty strong. The economy's pretty good. Stock market's at record high.
Well, yeah.
Some would look at that and say, you know what, the Fed has somehow managed to do its job pretty well.
Well, some people give credit to the president, too. But you're on the labor market. What's interesting is people keep talking about how great the labor market is, and it's good for sure. But the job growth under Trump for 3 years is less than the job growth of the last 3 years of Obama by about 10%. It's about 10% less. So that's not any better. What's better is people aren't getting laid off. That's what's better about the labor market. Weekly unemployment claims are really low. They're at about 200,000 right now, which is the lowest tick in a long, long time. They're down by about 30% from the last 3 years of Obama. So in the last 3 years of Obama, job growth, payroll growth was pretty good, but people were getting laid off to the tune of about 300,000 per week. Now it's down to the low 200,000. So that's a pretty big drop. So that, I think, is why the economy is perceived to be better on the jobs market, because the labor force participation has increased. It was under a steep decline for many, many years. And starting in about 2016, in the last year of Obama, it finally started to improve. And I think that's the good thing that's going on in the economy.
Well, you yourself have taken down your recession expectations.
Absolutely.
To like 35.
That's right.
Almost half of what you predicted when we last spoke.
Well, I don't know if that was when we last spoke, but in the summer, it was really in August.
Well, the point is, you're not expecting a recession anytime soon now.
I think that it's unlikely to be a recession at this point. The odds are against a recession occurring before the end of 2020. And what's happened is consumer confidence has really held up. And the year-over-year leading indicators from the Conference Board were at 7% year-over-year 15 months ago, which is really strong. And you have never had a recession in the last several decades without leading indicators first going negative. So that's really the canary in the coal mine. You have sometimes had negative leading indicators without a recession, but you've never had a recession without negative leading indicators. So it's a necessary and not sufficient condition. So leading indicators are low right now, year over year. They're around 0.4, but the numbers that are rolling off for the December-January period coming up are quite low. And so our forecast is that those will improve in the next couple of months, which makes it very unlikely that we'll have a recession, say, in the next 6 to 12 months. So it's down about 35%. In the summer, don't forget that there were white papers being released on Wall Street encouraging the Fed to do an inter-meeting 50 basis point emergency cut. That's how bad some of the manufacturing data was getting globally. There's a little bit of improvement in that as well. So the recession outlook would really depend. To forecast the recession at this point, there's 2 things you have to watch. The consumer view of the present would have to deteriorate, and it's still pretty high. And you have to see those initial weekly employment claims going up to about, well, they have to go up probably from 203 or so thousand where they are now to probably 250,000. And there's no reason to believe that that's going to happen.
How do you foresee the trade war playing out? I mean, you could have more tariffs on as early as a handful of days from now. Is that potentially impacting your perspective and point of view?
When it comes to the trade war, I've been consistently stating that there will be no trade deal until the 2020 election. There's absolutely no reason for China to do a trade deal on the terms that the United States wants when there's an election coming up in less than a year, and potentially they could have somebody else that is more old school and wants the genie back in the bottle and would take the tariffs away.
Are you talking about a full-scale trade
Yeah, I'm talking
deal?
about a real trade
So
deal.
you could have a phase one or phase two, or whatever
one.
you want to call it.
The phase one thing was really something. I mean, it was a private language. It came out of nowhere. Some Friday afternoon, all of a sudden, we have this phase one trade deal. Looks to me like it's more like phase 0.1 trade deal because nothing is happening. That's just rhetoric to try to make it look like there's progress happening. I think the phase one trade deal day, that press conference was the low point in Trump's presidency. I thought that was really almost shameful because we had never talked about phasing a trade deal. It just came out of the blue, and he said something about 50 billion tons of soybeans being bought by China. And then I learned on Monday, I got a white paper from an economic consulting service, and they said that actually what China agreed to was thinking about buying some soybeans 2 years from now. So that doesn't sound much like a trade deal to me. The real nub of the issue is really a problem, and that's the intellectual property. And China doesn't want to do anything on intellectual property theft, and that's probably the most important thing from the United States' point of view when you think longer term. And so for that reason, what's really important in the trade deal is intellectual property. That's not going to happen, and that's why we suddenly came up with this kind of escape hatch, which was this phase one trade deal, which I think is just nothing. And I don't even think there's going to be anything resembling a substantive trade deal before the election. I felt that all year. I remember back in May, we were talking about the tariffs were going to be removed. It was like May 10th or something. The tariffs were going to come on, and it was like, oh no, they're not going to come on, but they did. I just think that this is something that is a long-term problem. We're not going to see a solution thanks to the fact there's a presidential election that's contested in November.
Let me step away just for 2 seconds, and it's a good segue because we're having this conversation to go to my colleague Kayla Tausche in Washington, D.C., who has a news alert for us. Hi, Kayla.
Hi, Scott. The Business Roundtable holds a quarterly briefing for reporters to talk about its own indicators of CEO confidence and the economy at large. Jamie Dimon, in his role as outgoing chairman of the BRT, in this briefing made some comments about the Fed. He was asked about the repo market going into the end of the year, and he said he believes that repo continues to be a minor issue, but that, in his words, it could become not minor if the U.S. economy begins to weaken. He also suggested that regulators should reconsider banks' deposits on hold at the Fed. These are liquid assets like treasuries and gold that they hold for rainy day purposes. He says now banks have so much additional liquid capital on hand that perhaps that is one reason why the market is seeing an impact there, that perhaps there could be some asymmetrical and unintended consequences because of those issues. He was also asked about the Fed's decision today. He said that he would be happy if the Fed did not cut rates further because the U.S. economy was strong. And he said even when the Fed does cut rates, it only helps the market a little bit and not as much as everybody thinks. Scott?
Kayla, we appreciate that. That's Kayla Tausche covering the Business Roundtable. This idea, the repo market, what's gone on there throughout the balance of the last few months, since September, really?
September 17th was a day where there was tax payments and there was a bunch of bills being issued that were
we got trade desk, which I think is
maturing. So there was a little bit of a liquidity problem September 17th. What's interesting about that is the repo market, the overnight repo market, had been struggling to stay in line with the Fed funds rate, but that day, September 17th, it just blew out. In about an hour, it went up to about 10%, and the Fed sort of had to panic and come to the rescue by adding reserves to the system. That, to me, is a worrisome development because it suggests that the market doesn't ratify the Fed funds rate. The Fed has the Fed funds rate at a level that really isn't clearing the market in a free market way for overnight money. And what they're doing is they're adding reserves to try to counteract that. That corroborates my viewpoint, which I think is a minority opinion, that in the next recession, if the Fed doesn't do quantitative easing, and Jay Powell has said he will, if we can believe him, and he doesn't have a good track record on believability, but in the next recession, the amount of bonds that would be issued at the long end would be so horrifically high that I think interest rates in a normal free market clearing mechanism would rise, and rise fairly significantly. And that's what the repo market is kind of telling us. On September 17th, overnight money was over 2%, and the 10-year Treasury was below 2%. It's really telling that you can't find buyers for overnight money in excess of a 2% interest rate, and yet the 10-year Treasury is below 2%, with inflation at 2% and higher. It tells you that the interest rate levels that are being maintained by the Fed really are not market levels, they're manipulated levels. In the next recession, right now, the national debt is growing at over 6% of the economy. So $1.27 trillion was the growth in nominal dollars of the national debt in fiscal 2019 that just ended. That's more than the growth of nominal GDP in dollars. In other words, all of the growth of the economy in nominal dollars has been the growth in the national debt. We're at 6% national debt growth is consistent with the depths of recession with Keynesian stimulus. When the next recession comes, it is likely that the national debt will go up to double digits growth, which would mean bonds being issued in the many trillions of dollars. And I don't think the interest rates would clear at that level without the Fed getting involved with quantitative easing. So the Fed is kind of on the case here. They understand what the problem is. They understand that we have a debt compounding problem and that interest rates would get completely out of control and lead to a mega recession. Imagine if in a recession mortgage rates went up, what that would do to the economy. But the Fed, I believe, will counter that. And what they're doing with the repo facility being increased is kind of proof positive that they are manipulating interest rates and intend to do so in the next recession.
Credit Suisse makes what some have termed a stunning call yesterday, calling for QE4 by the end of the year to deal with stresses in the repo market.
Are they doing QE4 already? They say they aren't, but the balance sheet has already taken back 40% of the quantitative tightening that was done during 2018 into the early part of 2019. So they're already expanding the balance sheet. It's already back to over $4 trillion. They don't call it QE because I guess technically it's growing the repo facility and not buying coupon bonds. So it is different from what they did during 1, 2, and 3. But I mean, stylistically, it sure looks awfully similar. You're adding stimulus liquidity to the system, which is helpful. I mean, that's one of the reasons why I think the risk markets have had this second wind. I think if the Fed had executed on their program that they were talking about 12 months ago, we'd be in horrific market conditions. It's just that the market broke the Fed's resolve.
So then, given everything that we've discussed since we started the conversation at the top of the show, where are interest rates going in the near term? Okay.
The short rates are staying the same, and I think that that's perfectly corroborated by the shape of the yield curve. I mean, Fed funds are basically 1 5/8. The 2-year Treasury is at 1 5/8. The 5-year Treasury even is very close to 1 5/8. So interest rates are going to be on hold for the Fed for sure. And again, I can't emphasize enough that October statement by Powell, where he said we're not even considering raising interest rates unless we see a substantial and persistent rise in inflation. When you hear that the Fed is cheerleading inflation higher, and our models show that the CPI is going to be 2.5 in a few months, and our model has been incredibly accurate, almost to the basis point. What that says is that the path of least resistance for the 10-year is higher interest rates, until such time as the Fed manipulates it lower.
How high? Like what's the level on the 10-year that you're willing to go out on?
I think that the 10-year now is about at 183 or so, and it looks to me like there's some pretty good yield resistance at about 205. That should be what contains this move up from 140. But there's a potential, I think, for if there's economic weakness, there's potential for something that resembles an echo. I'm not sure it would be as robust, but potentially an echo of the taper tantrum. Way back in the middle of 2013, we had a 150 basis point rise in the 10-year in 6 weeks. That's simply because Ben Bernanke said we're thinking about tapering our quantitative easing. I kind of think that if we get economic weakness along the way, which I'm not expecting in the near term, you could see a move back up to 3.25 on the 10-year, and I think that would get the Fed back into quantitative easing 4. So Credit Suisse might be right, but I don't think they're going to be right in the next 3 weeks.
Okay, so in terms of that forecast and how we should be positioning ourselves as investors and those who are watching the program for actionable ideas from you, today, you urged investors should start, quote, playing defense now. What does that mean?
Well, what I said in my September webcast for my total return fund, I said I think we've seen the low in the 10-year for the year, and the 10-year was about at 150 at the time, and that was the case. So you should be playing defense relative to interest rate risk, because interest rates at the long end, the path of least resistance, absent the Fed going into QE4, is for higher, I think, longer-term interest rates. But when I'm talking about playing defense, what I'm really talking about is credit risk, because credit risk, to me, right now, is very dangerous. There's a whole cocktail of fundamentals that I think lead to wanting to be early on exiting the corporate bond market. And I think the time to be exiting the corporate bond market is presently, because the corporate bond market is enormously bigger than it was prior to the global financial crisis. It was around $5 trillion then. It's $11 trillion now. And the corporate bond market is, I believe, misrated. There's a study by Morgan Stanley Research that I've been referencing now for quite some time. They've been doing this for quite a few years, that basically says, let's pretend that Morgan Stanley Research is a rating agency. And let's pretend that they're completely objective, but simplistic. So all they use is leverage ratios of corporations' debt in assessing what their rating should be. Morgan Stanley Research Department says that if you simply use leverage ratio, that 39%, fully 39% of the investment-grade corporate bond market should be rated junk right now. Imagine that. They're not rated junk right now because they're being a little bit lenient, I believe, relative to their downgrade system at the rating agencies. But if 39% of the corporate bond market would be downgraded to junk, you would see some pretty horrific movement against a backdrop of corporate debt to GDP being at an all-time high, and the leverage ratios of net debt to EBITDA in both the investment grade and the junk bond market are at all-time record highs. So spreads are extremely narrow in corporate bonds. In fact, they're narrower than people think. People look at historical charts. They go back several decades and they say, how much extra yield do I get from investment-grade corporate bonds versus treasuries? And the conclusion you draw from that is it's kind of low by historical standards, so that raises a caution flag. However, the percentage of the investment-grade corporate bond market that's rated single A or higher is at an all-time low. It used to be 2/3 of the corporate bond market was rated single A or higher 25 years ago. Now it's 35% of that market. So the rating is actually worse. So the yield spread should be higher than average, not at near a low level. So that's a very bad sign. Also, there's a yield grab that has gone on because of yield starvation in Japan and Europe primarily that has caused tremendous buying of U.S. assets, particularly corporate bonds, because there's a yield there. If you look at the net investment position of the United States, it's collapsed over the past several years, with 49% of GDP value is the net negative investment position of the United States. So this is all foreign investment that's come in. Foreigners, you can understand, are buying U.S. bonds because their bonds are negative. If you're an insurance company in Europe, what are you going to do? You can't buy bunds at negative 20 basis points. That's just a sure money loser. So what they're doing is buying U.S. assets, and that's helped the U.S. market. It's helped the U.S. corporate bond market. But the problem is that if you buy the corporate bonds as a European insurance company, if you hedge the currency risk back, so you buy the dollars and you hedge them back into euro, guess what happens? You have a negative yield. You have a yield that's even more negative than the German 10-year Bund. So you can't hedge it. So what's been happening is European investors, insurance companies and the like, have been buying U.S. corporate bonds and not hedging them. And that's one of the reasons the dollar has held up, because they're not hedging it back. So there's incremental dollar demand. The dollar has been stable for sure this year. The Dixie index started the year at 96.25. I didn't look at it today, but it was at 97.5 or so yesterday. So it's basically unchanged. But the dollar should be falling based on two things. The first is when the Fed is easing, it's highly correlated to dollar weakness because, of course, the interest rate is less attractive. Also, when the twin deficits, the budget deficit and the trade deficit, are rising as a percentage of GDP, which has happened for sure in the last few years, it's highly correlated to dollar weakness. The dollar has held up because of this naked buying by foreign investors who are yield starved thanks to the negative interest rate policy. What you have to think about is what happens if the dollar actually starts weakening and or corporate bond prices start dropping, you're going to see a huge loss start to develop in these naked dollar holdings for these entities. And my belief, based upon 35 years of experience and how investors behave when they start to experience losses, is they will then start to have waves of selling.
They run for the exits.
Right. And so this is why I think you're supposed to be playing defense. I believe this is almost like 2006 relative to some of the over leverage in some of the, the civs and all that stuff that went on that caused the global financial crisis. It really doesn't matter if the problem happens today or a year from now. You're picking up a tiny amount of money in excess yield, and yet the downside flush will be such that you will see tremendous losses accruing. And I think that's the fundamental risk that faces investors, and that it's all happened because of the cumulative effect of this now not short-term negative interest rate policy. I was in Europe in September, and I hadn't been there for a while. And I was really struck by how the mood had changed since the last time I was there. The question used to be, well, we have to suffer through, how do we suffer through this temporary policy of zero or negative interest rates? That's off the table now. Now the conversation in Europe, at least from the large pension plans that I spoke to, was, what are we supposed to do? We're stuck with this forever, almost is the mindset. Should we take bonds, these negative yielding sovereign bonds, just out of the efficient frontier analysis altogether? Should we even forget about bonds as an asset class? In our pension plan, I said, well, negative yielding bonds, yeah, I think you should forget about them. But so that's what I mean by defense, is that the consequences of these policies are building up. And when the dam breaks, it's going to be a pretty big flush down. It's not worth picking up 50 basis points today when you're going to be losing 30 or 40%. In bonds, you make money slowly and you lose money quickly.
You know that there are going to be people listening to this saying that Gundlach and others have been making these dire predictions about corporate bonds and high yield for years.
Well, that's not true.
And you're saying, well, you'd rather be...
It's just not true that I've been making dire predictions about corporate bonds for years. It's just not true. I mean, I made dire predictions about corporate bonds at times over the past years, but those have been good predictions.
Okay, let's say at times. At times.
Well, look what happened in the fourth quarter of 2018. I mean, the corporate bonds were terrible.
But this is taking it to another level. Did I read you're looking at a?
I'm talking about it is another level. You're right. It's another level. It's a cyclical level. It's a fundamental economic level. There were problems in the past that had to do with sort of shorter term considerations. I'm really zooming back and thinking longer term. It was interesting. I gave a speech to a really big aggregator audience a few months ago, and the head of the thing said, "Let's do a fireside chat format." And I said, "That's great." And he said, "What I want to do is something a little different. I want to focus on like the next 6 or 8 years." And I said, "That's great, because that is exactly the way I'm thinking. I'm not thinking 6 months. I'm thinking by the mid-2020s, and I know that's not imminent, but by the mid-2020s, all of this is going to happen. And I think that the consequences of it happening are so substantial that that's the fundamental driver of how asset allocation policies should be set. Just like in 2006, the idea was, or even 2005, the idea was, this nutty underwriting cycle that we've found ourselves in is going to end with such a catastrophe that you want to sidestep it, and it's fine if you're a year or two early.
Okay, I'm glad you put context on it. I think that's helpful for everybody to hear. This is not something imminent that you're talking about.
You're talking chance of recession.
Well, and that's what causes the blow up is a recession.
It could be 2022. I mean, who knows? It could be 2021. I don't think it's going to be the next 12 months, though.
Okay. Let's take a quick break. We'll come back. We'll have much more with Jeffrey Gundlach on this topic, including, well, he predicted Trump winning in 2016. We're going to get his take on the political landscape and more of his outlook for 2020 straight ahead.
It's human nature.
Along the goal line, scores! It takes it home!
Hockey fans, the 2019-20 NHL season is here.
Here's Pietrangelo, he scores!
And you can hear Hear the action live on TuneIn Premium.
Move, and a shot, they score!
From regular season action to the All-Star Game and through the Stanley Cup in June. Hear the home and away call for every game, for every team live. At home or on the go, never miss a game with the NHL on TuneIn Premium.
Upgrade today.
We can't make traffic move faster during rush hour. But we can help you catch up on the news with TuneIn. With live around-the-clock news from MSNBC.
In the UK, they're significantly worse. When the president gets up to the podium...
CNBC and Fox News Talk.
The Fox News poll sizing up the race for 2020 found that each of the 5 top Democrats...
You can use your stop and go for good by staying in touch with the world. Search news to hear what's happening now.
When you're not listening to your team, take it to the end zone, the rim, or the net. Keep up with the biggest moments in sports by following TuneIn on social media.
Block, Cook into the end zone for the touchdown.
From reminders of the live top games to tips of the best sports stations and podcasts.
Welcome to Undisputed. We are live from Los Angeles. I'm Jenny Taft here with Skip
Follow at TuneIn on Facebook, Twitter, and Instagram to get the most out of TuneIn.
Upgrade to TuneIn Premium and get over 45 commercial-free music stations. You'll also get live commercial-free news, plus live play-by-play games from NFL, MLB, NBA, and NHL. Visit TuneIn.com/premium to upgrade.
Hey, TuneIn listeners, Steve Kornacki here from NBC News. I want to tell you about a podcast I'm hosting called Article 2, Inside Impeachment. It's dedicated to bringing you the latest developments on the impeachment inquiry into President Trump. Every Monday, Wednesday, and Friday, I talk to NBC News reporters who are closest to the story to break down what's new, what matters, and what it means for the 2020 election. Search and favorite Article 2, Inside Impeachment on TuneIn.
Welcome back, everybody. I'm Sue Herrera. Here's your CNBC News update at this hour. Harvey Weinstein's bail was increased from $1 million to $5 million over allegations he violated his bail terms by mishandling his electronic ankle monitor. The judge rejected prosecution calls to jail him. Weinstein arrived at court using a walker, his lawyer saying that he will undergo back surgery on Thursday. A powerful suicide bombing targeted a medical facility under construction near Bagram Air Base. 6 Afghans were reported injured. There were no casualties, though. The attacker struck the facility that is being built to help the Afghan people living in that area. Iran's telecommunications minister says his country has defused a massive cyber attack on its electricity infrastructure, but they provided no specifics on the purported attack. He says authorities are investigating its exact dimensions. And the gown that Princess Diana wore when she danced with actor John Travolta at the White House was sold at auction for more than $280,000. The gown offered by the charity that looks after her former palace. It was expected to fetch between $320,000 and $385,000. You are up to date. That's the news update this hour. Scott, I'll send it back out to beautiful Los Angeles.
Princess Diana's gown or the banana? About the same price.
That's
Sue,
true.
thank you so much.
You got
Once
it.
again, we are live at Double Line headquarters in downtown Los Angeles with Jeffrey Gundlach. You were saying about the gown?
Well, it was just something
as an
that
art
came across
collector.
the crawler, and they said that the Princess Diana's gown went for $230,000, and I had to laugh because Catalan's banana went for $130,000. So a banana sold for the same level as Princess Diana's gown, roughly. I mean, in the same context. That banana is just genius stuff, I've got to tell you. I've got one hanging up over there, and it cost us 40 cents, I think. And Catalan sold them for $130,000. Best investment of the year.
Yeah.
He bought a banana and some duct tape, and it went up to $130,000 in a minute.
All right, well, there's inflation, at least somewhere. So let's pivot and talk about politics, if we could,
Sure.
because you'll probably get credit until the end of time for your prediction that Trump would win in
Before the
16.
primaries started, I said.
Okay, so now what? What happens in 2020?
Well, the base case right now is Trump is going to win re-election. That's the base case right now, because the Democratic Party is kind of in disarray, it seems to me. I mean, you look at the polling, and we've been at this now for, 9 months, 10 months, or something like that, since some of these candidates got in, and there isn't a single candidate that has captivated the imagination of the Democratic Party. You've got Joe Biden, who they say is durable because he's not collapsing in terms of his polling, but he's also not going up. If you're really going to be a front runner, you need to show some momentum. And Joe Biden has been basically at the same level since before he announced, really. And he just doesn't seem, it just doesn't seem like it would be enjoyable to watch the decimation of Joe Biden in a one-on-one debate with Donald Trump. I just don't think that he can formulate paragraphs the way he used to, and when you see him in the debates. So I just don't think that he's viable. And then you start going to the socialists, Bernie is also completely flatlined. Bernie's Bernie, you know what you're going to get. I give him a lot of credit for bouncing back from that heart attack. I mean, he came back and he was exactly the same guy 2 weeks after a heart attack. Got to give him credit for that. But there's nothing new there, and he isn't going anywhere in the polls. Elizabeth Warren, once you go from 52 cents to win $1 on PredictIt, which is where she was a couple of months ago, to, I didn't look at it today, but I think she was at 14 cents at one moment yesterday. When you go from 52 to 14, you don't recover. It's over. So it's over for her. Then you've got Pete Buttigieg. Pete Buttigieg, when I heard that the mayor of South Bend, Indiana, was running for president, I literally laughed out loud. But then I heard him speak, and he is good. He is a great speaker. He's probably the best on his feet of any politician since Ronald Reagan. He is so good. However, he's so young. I just have a hard time believing you go from mayor of a city of 102,000 people. How many votes did he get when he won mayor of South Bend, Indiana? 20,000? Maybe? 15,000? I mean, it's a big step to go from 15,000 votes to 60 million votes. And I just think he just looks so young. He's 37. He looks like he's in his 20s.
You're leaving out, of course, a big name in the newest entry
Bloomberg.
into the race, Bloomberg.
Yeah, he has no chance. I just think there's no chance there. I think that he right out of the gate has a lot of big problems. The first is I don't think mayor of New York City is a great credential for running for the president. New York is a unique place. It's kind of like Kamala Harris. They said, oh, she's senator from California, so that means that she's got a springboard. No, California is different from the rest of the country, and New York City is more like California than the rest of the country. And Bloomberg, with his stop and frisk, that's a problem. That's a really big problem. And with his regressive taxes on the poor for sodas and other manipulative types of behavior manipulation taxes, I don't think that's going to work. And also, it's tough when you're already late to the game. So I really give him very little chance.
Even with his $50 billion.
I don't think that's a positive. In the Democratic Party today, where vilification of wealth is a common theme, it seems like a delicious irony that one of the people that's running is the eighth richest guy in the world with $50-odd billion. It just seems so out of step with the tone of the party. I have a hard time believing it. I think the strongest Democratic candidate would be Hillary Clinton.
Now, you said that on the webcast yesterday. You were serious.
I am serious. She's the strongest candidate the Democrats have. That doesn't mean that she's a great candidate. It just shows the fractured nature of the party, and the consequences of that fracturing are a lot of. It's really two or three parties. It's very much the Democratic Party here for 2020 is very much like the Republican Party ex-Trump was in 2016. It was a whole bunch of kind of non-impressive candidates that were somehow trying to fit themselves into a mold without a real overarching ideology. I think that's sort of the problem there. So the base case really is that Donald Trump is going to win re-election.
Who are you supporting?
I don't support political candidates.
If the status quo remains and Trump does win, what does that mean for markets?
Well, it's probably more positive than him losing, I would say, because the rhetoric, the themes of the opponents certainly are probably anti-market. I mean, one of the questions, you mentioned my webcast yesterday, one of the questions that came up, someone said, is the market overreacting to Elizabeth Warren? And I said, what are you talking about? Elizabeth Warren is obviously not being taken seriously by the market. If the market was taking Elizabeth Warren seriously, it would not be at near an all-time high. It would be down substantially because she clearly would want to have anti-corporate policies. One of the reasons that the stock market did well under Trump, for sure, is when you cut taxes, you turbocharge the bottom line. Earnings go up on a net basis. Elizabeth Warren vows devoutly that she's going to reverse that, and so do many of the Democrats. So the market is actually telling you, I think, that the base case is Trump is going to win, and so that would continue to be a supportive aspect to the market.
Is that playing into where you think money's going to be made in the couple of years ahead, expecting that Trump's going to win and then positioning therefore?
I think
because if you're worried about
buy the rumors, sell the news type of situation, I think the reality of the market positives for Trump are in the market. I think the market has absorbed those and believes in it. I actually think that much more than politics, I think what's really important for making money in a couple of years ahead is I think you have to start fundamentally believing that the dollar is going to get weaker. And I think you're supposed to orient your thinking around that, which means that foreign currency investments should be superior to U.S. dollar investments. I think that the dollar topped almost 3 years ago on the Dixie basis. It was at 103, and it's down at a 97 handle today. And I think that we go back and take really big picture views. My favorite chart of this year, we may have talked about this before, but it's worth repeating if we didn't, or even if we did. If you go back to the 1980s, so very long-term view, you could divide the world into 4 regions: Japan, Europe, United States, and emerging markets. And something very interesting has happened. Over that 35-year or so period, there's been every one of those 4 regions has had a moment where they were world beaters. They were viewed to be invincible. First, it was Japan in the late 80s. It was invincible. The value of the Imperial Palace land, which is fairly small in Tokyo, was actually viewed to be the same as all of California. Japan was that strong. They were manufacturing everybody out of business. Remember? The Nikkei was by far the best stock market in the late 80s. Then the recession came in the early 90s, and the Nikkei was the worst market, and it hasn't been back since. 30 years later, it hasn't come close to that 1989 level. Then came the euro in the late 1990s. There was tremendous enthusiasm. It would be a reserve currency potentially. There'd be a lot of cooperation. It was the ascendancy of Europe, and the European stock market was by far the best in the late 90s. Then came the recession, the early 00s, and it got kneecapped. Hasn't been back there since, 20 years later. Then, in the middle of the 00s, it was a weak dollar. Emerging markets were strong with the weak dollar, and China was very much on the rise. And emerging markets were by far the best stock market in the world. Now, what happened? Global financial crisis. Emerging markets got wiped out. They haven't been back since. Well, who's the world beater now? For the last 10 years, by far, it's the United States. The S&P 500 has blown emerging markets, Japan, and Europe totally out of the water over the past 10 years. That's partially because earnings have been better in the United States. It's partially because economic growth has been better in the United States. It's also because of financial engineering, which ties into that corporate bond thing, where you're able to get a lot of free money for corporations to do buybacks. It's also the tax cut. Well, my view is that this pattern will repeat, and that in the next recession, the United States will be the worst stock market in the world. The dollar will be weak, and I don't believe we'll get back to whatever highs put in again in my career, similar to what happened to Japan, then Europe, then emerging markets. So I think that's what you're supposed to be thinking about, and the linchpin to that thesis is that the dollar will be weaker thanks to the exploding deficits and the Fed going back towards zero.
Let's take another quick break. We'll have more coming up with Jeffrey Gundlach. Plus, we are catching up with our investment committee. They're back at shop. Software stocks are gaining 30% this year. Cowen names one big player a top idea for 2020. We're going to debate that coming up. And John Najarian's tracking unusual activity as usual. He'll have that for you when we come back.
Is the monolithic view of emerging markets obsolete? Christmas. A time for celebrating, unwrapping, and unwinding. Capture every moment with an epic iPhone 6S with a 12-megapixel camera. Now only $12.99 a month from Tesco Mobile, saving you £72. It's just one of the ways we're celebrating 100 years of great value. Go in store or search Tesco Mobile. Tesco Mobile. Every little helps.
Saving £2 per month over 36 months was £14.99. 36-month credit and rolling monthly usage agreements required. Subject to status. Terms apply. See tescomobile.com/terms.
To LeBron. Slam dunk.
The NBA is on TuneIn Premium. Each week, TuneIn picks an NBA game you just can't miss. The Miami Heat are taking their talents to Texas to take on the second-year phenom, Luka Doncic, and the Dallas Mavericks.
Back trying to make it 11-2.
This Saturday, the Miami Heat are at the Dallas Mavericks. Tip-off is at 8:30 p.m. Eastern. Search NBA on TuneIn to follow your favorite NBA team today.
Did you know your favorite radio stations are in your pocket? Yes, the TuneIn app lets you listen to the same radio stations you pick up on your home or car radio anywhere you want. To see all the stations broadcasting in your area, find the local radio section on the home screen. Keep it local with TuneIn.
From ESPN and the award-winning producers of The Sterling Affairs comes the latest season of 30 for 30 podcasts. 4 brand new stories of espionage.
He wanted this team to be the Barcelona of women's basketball.
Resilience.
I started to scream. I tried to get away.
Corruption.
It's the culture of win at all costs.
And rebirth.
How will we ever rebuild it?
30 for 30 Podcasts, Season 6. Listen now to 30 for 30 Podcasts on TuneIn.
Hey, NFL fan, can't watch the game? Can't be there? We've got you covered. With TuneIn Premium, you can listen to every NFL game live as it's happening.
LaShawn McCoy has an opening on the right side, punches into the end zone for the touchdown.
Or catch it later on demand.
Offset backs behind Mahomes. The give is to Williams. Starts right, cuts it back to the left, and blows into the end zone for the touchdown.
You call the plays. Follow the NFL anytime, anywhere, all season long with TuneIn Premium. Upgrade today.
In the stock market and in life, everything can change from 1 minute to the next. Be the first to hear the latest money news and market trends with CNBC on TuneIn. Wherever your day takes you, listen to CNBC's full slate of programming, including shows like Fast Money, Squawk Box, and Mad Money with Jim Cramer. And when the next big business story breaks, CNBC lets you know with live updates and commentary. At the office, at home, or on the go. Search CNBC on TuneIn to listen.
The ETF that tracks software stocks has jumped over 25% in the past year. According to our data partners at Kensho, after similar gains, the trend continues, with the ETF outperforming the S&P 500 3 months later and trading positively 77% of the time. For more, go to cnbc.com/Kensho.
We're back. Cowen naming top software player Salesforce the best idea for 2020. We've made that our call today. Joe, John Weiss, and Megan Shu are back at our headquarters in New Jersey. Weiss, you get the first crack at this. It's interesting. No one on the desk owns Salesforce. The stock is up 15% this year. Steve, you choose Adobe and Cloudera over this name. Why?
Well, Adobe I bought because it really got trashed. If you recall, there's an analyst downgrade. They supposedly missed the quarter, which I don't think they did. So it was an opportunity to get involved in a company that I don't think really has much competition. The recent IPOs haven't done well. In terms of Salesforce, it's always a question of valuation, but it's always expensive. I've been looking at Salesforce. I predict I will own it within the next year. It's consolidating. It's really done nothing for this year. I think it's a quality company with phenomenal management.
The guidance was weak, Scott, for Salesforce. They need to lift the margins in the coming quarter. I think that's a story. Over the last 18 months, they've done $24 billion in acquisitions, Tableau, MuleSoft, Click Software. The trade-off of this is DocuSign. It's worth $12 billion in the market. I think DocuSign gets acquired by either Salesforce or Adobe.
Yeah, it's interesting, having this conversation coming off the last couple of days that we had in San Francisco, where it's all about software. Software is the rage, the cloud's the rage, and it's going to be moving forward. By the way, shares of Ambarella are up over 50% this year, and options traders are betting on some more upside ahead. John, you have unusual activity for us. What are you seeing there?
Yeah, Scott, exactly right. Shares began about $36 this year, screamed up to 65. Now they're, let's say, 53. They're coming in and they're buying the 55 calls, Scott. Aggressively, they've been buying these calls today. So semiconductor for video and HD and all that, I bought these calls. I'll probably be in them, probably January 10th expiration. I'll say I'll be in 3 weeks. Second one real quick, Williams, WMB. Oil and gas infrastructure, in particular pipeline, Scott, a lot of play on this one. They came in aggressively buying February 23 calls. You got a lot more time with this. I'll be in there about a month and a half. Love the activity. Over 12,000 traded so far.
Okay, good stuff. Thank you for that. Hey, get your questions ready. Guys, we're going to take a quick break. We're going to come back. We'll have more of our halftime exclusive with Double Line's Jeffrey Gundlach in 2 minutes. Some Q&A from the investment committee with the Bond King is next. The countdown is on to the Fed decision just over an hour away. Plus, Chairman Powell's news conference coming up. Don't want to miss that. There's the countdown clock. We're about 2 minutes away from a return with the Bond King.
Can you customize the S&P 500 to meet your client's income objective?
The puck drops. 12 players face off to win. The suspense is pure torture, but you wouldn't miss this for the world. TuneIn brings you every minute of the NHL season. Listen live to hockey when it matters most on TuneIn.
Want to hear about the latest and greatest things to listen to on TuneIn? For reminders of the biggest live sports games, debates, and breaking news stories, follow @TuneIn on Facebook, Twitter, and Instagram to stay connected with the audio that matters to you.
Hey, NFL fan, can't watch the game? Can't be there? No biggie. With your TuneIn Premium membership, you already have an all-access pass to every team and every game in the league. Amazing, right?
Steps up, floats it towards, at the goal line, it's intercepted!
Listen live as the action unfolds or on demand when you can. Anytime, anywhere, all season long.
Right side, it is caught, it is in for the right side for the touchdown.
Search NFL today.
Want to know a quick, easy way to see if your favorite podcasts have a new episode available? Just go to the home screen on your TuneIn app and see the latest editions under the Your New Episode section. Happy listening.
Ah, finally another commercial, said no one ever. Visit TuneIn.com/premium to upgrade now and get over 45 commercial-free music stations.
Far wing, elevates, triple bucket.
The roar of the crowd. The shot clock ticks down. Will the ball go in? The suspense is pure torture, but you wouldn't miss this for the world. And the replays just don't cut it.
The sideline, the Van Fleet for three.
TuneIn Premium brings you every minute of the NBA season streaming live, so you can be there when it matters most. Hear it now. Hear it live on TuneIn.
Pump fake in the lane, turnaround jumper from 8 feet is good on the
Search
right block.
NBA today to start listening.
Hey, NFL fan, can't watch the game? Can't be there? We got you covered. With TuneIn Premium, you can listen to every NFL game live as it's happening.
LaShawn McCoy has an opening on the right side, plunges into the end zone for the touchdown.
Or catch it later on demand.
Offset backs behind Mahomes. The give is to Williams. Starts right, cuts it back to the left, and blows into the end zone for the touchdown.
You call the plays. Follow the NFL anytime, anywhere, all season long with TuneIn Premium. Upgrade today.
In the stock market and in life, everything can change from 1 minute to the next. Be the first to hear the latest money news and market trends with CNBC on TuneIn. Wherever your day takes you, listen to CNBC's full slate of programming, including shows like Fast Money, Squawk Box, and Mad Money with Jim Cramer. And when the next big business story breaks, CNBC lets you know with live updates and commentary. At the office, at home, or on the go. Search CNBC on TuneIn to listen.
We are back live on the trading floor of Double Line in downtown Los Angeles, back with Jeffrey Gundlach today. Joe Terranova, I'm going to open the floor to you. It's yours. You have a question for Jeffrey.
Thank you, Scott. Fantastic content so far, Jeffrey and Scott. I'm ready to go out and buy my tips, Jeffrey, after listening to you. But I want to ask you about the mortgage market because
I like tips.
Yeah, certainly the way you sound today, we both like tips. But the mortgage market, the lion's share of allocation for taxable fixed income portfolio managers has been in the mortgage-backed security market. How am I thinking about mortgages in 2020 in the environment that you described? Because there seems to be a significant overweight to that.
I'm not really sure that I agree with that. I think that there's more of an overweight into corporate debt than there is into mortgage debt, although there's certainly funds like my total return fund, for example, that have a lot of mortgage debt. I don't really think there's an overweight there. Our analysis actually shows that mortgages are relatively cheap at the present time versus corporate bonds and treasury bonds. So I don't really think that it's been an underperforming sector this year. The sectors that have really performed have been the riskier sectors in the bond market. Emerging market debt is up 12.6% year to date if you do it in dollar terms. and it's not much different in local currency terms. Corporate debt is shockingly high. Junk bonds are up over 12%, and investment-grade corporate bonds are up over 14% year-to-date, which is kind of amazing because Treasury bonds are only up about 7%. So my opinion is that mortgages have lagged over this interest rate decline thanks to prepayment fears. With the mortgage rates having fallen so much, with the 10-year Treasury dipping down below 150, we saw an increase in prepayment rates, which are problematic for mortgage-backed securities. So with interest rates going up a little bit since August, and my viewpoint, they might go up a little bit higher, the mortgage market is probably one of the better places to be in the investment grade bond market right now, I think. So I'm not really worried about that at all. I'm much more worried, as we talked about with Scott, about the longer term problems with over-indebtedness of corporate America and over ratings in that sector.
You mentioned your total return fund. You have no corporate debt.
Never have. Never owned a single corporate bond. Now, we do own a small amount of the very top of the capital structure in CLOs, which are bank loan resecuritizations. But since they're at the very top of the capital structure, they don't really share the same type of exposure you would have down in middle-rated debt. So with that exception, we've never owned like an AT&T bond or any other sort of corporate name in the total return bond fund. It's one of the ways that we basically have developed lower volatility over the many years because it's the lower volatility sectors. The corporate bond market's the higher volatility sector.
Steve Weiss, you have something for Jeffrey?
Yeah, so I'm curious about just our economy and our debt load. So the balance sheet, Fed balance sheet is back up to $4 trillion, which is where it was during the worst of times. Will there ever be a catalytic event that will cause the markets to care about it? Because right now the markets just don't care. We can add debt after debt after debt. And you as a bond guy and sovereigns, you're right in the heart of this.
Yeah, it's a really good question. You know, I see two parallel things that are kind of metaphorically equivalent that are going on that have to do with short-term considerations versus long-term considerations. One of them is the debt level of the United States, which is certainly a long-term consideration, but it's been talked about for so long, and it's never really been a problem yet. So we've glued many short terms together in terms of using a debt-based economic growth scheme. But eventually, when you glue a lot of short terms together, at some point it turns into the long term. And what's metaphorically similar to that is negative yields in Europe and Japan, particularly Europe, where they are trying to battle problems in the economy and try to get stimulus with negative interest rates, but they know that negative interest rates are ultimately fatal to the banking system. If you keep them forever, you ultimately end up bankrupting all your banks and insurance companies. So what we have is this odd world we're living in where we know that our policies in terms of the U.S. debt and negative interest rates in Europe are fatal in the long term. We continue to do them thinking that, well, over the short term, it doesn't matter. I really think that the big event that's going to make all of this start to become relevant and people care about will be the next recession. The Fed and the ECB and the BOJ are fighting an economic downturn with everything that they have. And they've been able to forestall it. But they can't forestall it forever. And when the recession comes, the debt to GDP will be so high, as I said earlier, that interest rates left to their own devices and market pricing would go up on the long end, I think, fairly substantially. So that's what we have to wait for. And the reaction to that will be some pretty shocking policies. I mean, we've seen shocking policies already through QE and negative interest rates and the like. And now we have candidates talking about free money. Andrew Yang has made the debate stage for the 7th Democrat that's going to be on there December 19th. And his one policy is free money to people. And I think that will ultimately be the way out of our indebtedness. And that will cause inflation, I think, once we get there. So tips, yes, we like tips. Tips have done okay this year. I think inflation is being encouraged higher by the Fed. We'll probably hear rhetoric from Jay Powell in a short while that talks about wanting inflation to run hot. I don't know if he's going to use that word, but that's going to be the theme. And that's not exactly music to bondholders' ears.
We will hear what the Fed chair says. We have probably 30 seconds left. You got your 10th anniversary this week.
Unbelievable. 10 years of double line.
You got another 10 years in you?
Oh, yeah. I've got 10 years in me for sure. I don't know about 30. but I definitely have 10. I want to see how this movie ends. I think that we're in what we call the fourth turning. There's a book by Neil Howe, Howe, called The Fourth Turning. I think everybody should read it. It's a kind of a political philosophy, sociological philosophy, and it talks about how we have to go through a new building of institutions that people can buy into. Because right now, nobody's buying into the institutions that were set up in 1950. And we've got to get past that. It's going to be very, very interesting, and I hope to share it with your viewers on CNBC.
We look forward to that as well. Thank you once again for having us here at Double Line.
Thank you, Scott.
That is Jeffrey Gundlach. That does it for us. The exchange begins right now.
Yeah, really terrific stuff, Scott. Thank you very much, and welcome to the exchange, everybody. I am Brian Sullivan. We have got a lot ahead. 60 minutes to go before the last Fed decision of the decade. Wow. And what a year it's been for Mr. Powell and crew. So what should you expect from the Fed and company for the next year? And how will it matter to your money? We're going to dive in. The barrels, they are just piling up. Chevron taking a massive write down. The CEO effectively saying oil prices, they're not going anywhere higher from here. This follows a buildup in inventories that took the market by surprise. We will dig into that as well. And here is a riddle for you. What do Area 51, Disney Plus, the Avengers, and Sri Lanka have in common? There is an answer, and we've got it ahead. But right now to the man who probably knows the answer, because he looked at iNews, our script system. It's Dominic Chu with a look at the markets.
I do know the answer to that, but I'm going to save that. That's a great tease. I know what this segment's about. But anyway, this is a very calm market, Brian. You would expect this going into the last Fed decision of the year, of the decade, as you put it. The Dow Industrial is down about 41 points right now, so fairly even at this stage. But remember, at the highs, we were only up about 23 points. At the lows, we were only down around 80. So again, very still market so far. By the way, with the S&P 500 flat as it is, can you believe it's been 42 trading days since the S&P has moved 1% in either direction? That's how still these waters. We'll see if they run deep. One place we are seeing some nice highs is in the semiconductor industry, because this particular ETF, the semiconductor ETF, the ticker SMH, is up 1.5% today, a confluence of events. Positiveness over 5G wireless, some analyst upgrades for certain stocks. All of a sudden, you've got a stock up here that's right now record highs. We'll put a star up there, and then the stock of the day so far, take a look at shares of Apple, because this continues its grind higher, up 0.5% today, far outpacing the market. Again, a record high for Apple shares. And Brian, this means that at current market values, Apple is worth $1.2 trillion. Apple shares still in the move in this key holiday season. I'll send things back over to you.
42 trading days, Dom, without a 1% move?
Pretty big, right? That's a lot of calmness in the market right now.
That has got me SMDH. Dom, thank you very much.
You got it.
Now to that Fed meeting and decision. As Steve Leisman has told you many times in the last 48 hours or so, no rate change is expected. But that does not mean there may not be some drama and intrigue, because we got to look forward, not backward. Let's check in now with Steve Leisman, who is live in Washington. Steve.
Thanks, Brian. A little context. With the Fed meeting just days after a blowout jobs report, the market would normally be waiting for and asking the question, when and how much will they be hiking rates? Well, not today. In a world of global economic weakness and trade wars, and where that tight job market hasn't generated much inflation, the question is, how long will the Fed be on hold, and what would it take for the Fed to move? Let's talk about three things here. One is Fed Chairman Jay Powell has said a material change to the outlook. Perhaps a trade deal might help the cause. And then finally, and maybe most importantly, a change in global economies and global interest rates. In the last press conference, Powell said that the bar is high to cut and maybe even higher to hike.
I think we would need to see a really significant move up in inflation that's persistent before we even consider raising rates to address inflation concerns.
So the drama is going to come in the Fed's forecast. In September, 9 members saw higher rates in 2020. That's likely to come down. It could be potentially 0. And Powell's also definitely going to be asked about concerns surrounding the repo or overnight lending market and the scramble for funds in the banking system that normally occurs at the end of the year. Question is whether the Fed is adequately prepared for it, whether it could be a source of renewed market gyrations, uncertainty, and stability. Brian, I think the one question is there enough cash in the system to get us over the year end?
Listen, that's Steve. Honestly, I think this repo thing, some people say it's not a deal. Some people say it may be everything. We're going to find out it's a big deal. We're going to let you get in the room, Steve, and we'll see you in a bit. Thank you very much.
Thanks.
Well, the Fed changing course pretty abruptly this year. Remember, they've cut interest rates 3 times since hiking them last December, which I don't need to remind you, dear viewer, tanked the market, sending stocks to its worst December since all the way back in 1931. So after that hat trick of cuts, is the period of monetary easing over for a long, long time or not? Let's bring in our Fed panel. Neil Hennessy, he is CIO at Hennessy Funds. Bryce Doty is Senior Portfolio Manager at SIT Investment Associates. And Julia Coronado, founder of Macro Policy Perspectives, with us as well on our big Fed panel. Julia, I would imagine you're one of those 100%, which my math tells me is everybody that thinks that we are not going to get any kind of a move in rates today. So what should we be looking for from the Fed?
So I think Steve laid out a nice menu. What would get them to hike rates? What are they focused on? I think there's also the repo market and where they're going on that.
Is that a worry? I've talked to people who say this is a big deal. I've talked to people who says, don't worry about it. It's happened before.
It's always hard to predict exactly when you hit that nonlinear moment in the funding markets. There are plenty of people who are worried about a year-end squeeze, so it's something to keep an eye on. Are they prepared? Well, they've got these facilities up and running, so presumably they'll step in as necessary to calm the waters. And then the other thing that we're keeping an eye on is there's a whole policy review that they're promising to give us a new framework by mid-year of 2020. So where are they on that? Lael Brainerd, just before the quiet period, put out a very interesting proposal for yield curve caps and average inflation targeting, and I would like to hear Chair Powell's view on that.
Okay, but I'll tell you what, Neil, you know what your clients like to hear? The fact that the stock market has been hitting record highs nearly all year. Is there any way that we can replicate in 2020 the kind of market gains, some say pushed by the Fed, that we had this year?
Well, I don't think it was pushed by the Fed. I think it was pushed directly by business and the amount of company profits and cash flow that's been generated through this last 12 months. I don't think we're going to replicate 2019. I think we're going to reverse to the mean, somewhere in the 6 to 8% range going forward. The Feds aren't going to affect business except in any way, shape, or form, in my opinion, in the next 12 months. Even if they raise interest rates a quarter or half a point, it won't do anything to the economy. If anything, if they raise rates, Brian, it could spur the housing market for people to get into instead of waiting and buying a home, because you can have a mortgage rate now under 4%. I mean, that's just wacko.
Well, okay, listen. I think that's the technical term, Neil, but we'll appreciate it here, Bryce. We know what happened last December, okay? And you're more than bond side of things. But the Fed raised rates, the market tanked, bonds went haywire. Earlier this year, we had the inverted yield curve, recession doom were imminent. None of this occurred. If the Fed were to raise rates next year, would it have the same impact it did last year? Probably not, because we're 75 basis points lower than we were then.
Right, and you get to the point where the bond market is going to look for that. If they resolve this repo mess, which they need to do, you're looking at a crazy amount of jobs being created, and core inflation's been running over 2%. At some point, the bond market's going to want to see the Fed do something like raise rates rather than being desperate or paranoid or terrified that they're going to keep raising rates. So we think the curve's going to steepen. We don't think the Fed's going to do anything today. And they're going to keep driving short rates lower, keep printing money, buying T-bills, and so forth. But the 10 and 30-year yields could go up because inflation isn't going down.
Okay, so did you watch
I'll take the other side of that one.
Well, hold on, because there's something else that I want to get to, because you see Scott's interview with Jeff Gundlach?
Yeah.
Jeff basically said, and I'm going to paraphrase Jeff, that the bond market is a spoiled brat, and the Fed is a weak parent. And the bond market gets what it wants by screaming, and the parent gives in. He basically said Jerome Powell is doing the bond market's bidding rather than a Paul Volcker who told the bond market where to go and you better get in line. Is the bond market or the Fed in charge of interest rates?
I think the bond market is. I think that the Fed
Jeff was right.
Well, on that piece of it, I think on the corporate bond part, it's a little more complicated. He thinks, half the BBB bonds should be junk. Well, they shouldn't. I mean, the coverage ratios are fine. I understand the leverage ratios are bad, so it's precarious. You're gonna see some volatility going into year end. Either way, I think the repo thing is really a mess, and they got to do something to get rid of this incentive that sucks all the liquidity out of the bond market. It's crazy, but they're paying banks to hoard cash. I mean, stop it.
And they are.
Stop it.
So, Brian, let's remember that Paul Volcker had a problem to solve, and that was very high disruptive inflation. And Chair Powell doesn't have that problem. So he can spoil his child. His child is very well behaved. Inflation is very well behaved. if we get a postponement of these tariffs on December 15th, we've already built that into our inflation baseline. You're actually going to see inflation drift a little lower next year. These cyclical pressures are so
even
muted.
With tariffs.
Yeah, so we think that it's adding about a quarter point right now, and we're just barely at below their target.
Okay, well, Neil, that's the bond market's problem. Our viewers' problem is that they would like to buy a bigger yacht, and so they need to make some money. And you brought along some stocking stuffer stock ideas. Tell us why NCR, the cash register ATM machine, and somebody called Itron look attractive to you and your team.
Well, both of them have low price to sales ratio, which is a main metric that we use here at Hennessy Funds. But at the same time, neither one of them pay a dividend. They earn around $3 a share. But they're technology companies, but they're stodgy technology companies, meaning nobody wants to own something like a coin-operated laundromat. I mean, how interesting is that? Itron has smart meters for water, gas, electric. You look at NCR, and you're looking at the kiosks in the airport, you're looking at the scanners in the stores. So you're looking at stodgy companies that are really making a lot of money, cash flow, have plenty of room to pay a dividend because they don't pay any now. Those are two. You can look at LPL that earns $7 a share, pays $1 dividend, 16,000 RIAs work for them. I mean, there's plenty of good companies out there without risking your money in the riskiest parts of the market, which are the high-flying tech market.
We like it. New ideas. You got the Santa tie on. Santa Hennessy, thank you very much. With some stocking stuffer ideas. Neil, Bryce, and Julia, thank you all very much. Have a great day.
Thank you.
All right, a lot more to do. We're just getting started. Here's what else is ahead on the exchange.
Coming up, the oil glut grows. Chevron takes a massive write-down as the crude supply begins to pile up even more. We'll dive into the sector. Plus, a big blow for Boeing from the FAA. And a look at what Disney Plus, Area 51, The Avengers, and Old Town Road have in common. This is The Exchange on CNBC.
Morning, everyone.
So, Minister, do you really think you can lower taxes and increase funding for the NHS?
Get an in-depth look at all the parties' spending promises. From the NHS to house building, the Times and the Sunday Times will guide you through. Pick up your copy today or visit thetimes.co.uk.
Upgrade to TuneIn Premium and get over 45 commercial-free music stations. You'll also get live commercial-free news, plus live play-by-play games from NFL, MLB, NBA, and NHL. Visit TuneIn.com/premium to upgrade. Like what you're listening to? Want to make getting back to it easier? Use the favorite button to keep track of the stations and podcasts you love on TuneIn. Just tap or click the heart icon to add it to your favorites. Then find all your go-to audio under the Favorites tab. Pretty easy, right?
To LeBron, slam dunk. The NBA is on TuneIn Premium. Each week, TuneIn picks an NBA game you just can't miss. The Miami Heat are taking their talents to Texas to take on the second-year phenom, Luka Doncic, and the Dallas Mavericks.
Pulls back, trying to make it 11-2.
This Saturday, the Miami Heat are at the Dallas Mavericks. Tip-off is at 8:30 p.m. Eastern. Search NBA on TuneIn to follow your favorite NBA team today.
Want to hear about the latest and greatest things to listen to on TuneIn? For reminders of the biggest live sports games, debates, and breaking news stories, follow @TuneIn on Facebook, Twitter, and Instagram to stay connected with the audio that matters to you. In the stock market and in life, everything can change from 1 minute to the next. Be the first to hear the latest money news and market trends with CNBC on TuneIn. Wherever your day takes you, listen to CNBC's full slate of programming, including shows like Fast Money, Squawk Box, and Mad Money with Jim Cramer. And when the next big business story breaks, CNBC lets you know with live updates and commentary. At the office, at home, or on the go. Search CNBC on TuneIn to listen.
All right, welcome back. There is a trio of important oil and energy-related stories today. Number one, Aramco begins trading and the market in Riyadh loves it. Two, Chevron taking a nearly $11 billion charge and effectively saying oil probably not going higher anytime soon. And 3, more proof. There is still way too much oil in America and in the world. Let us blast through all 3 and bring in John Kildo, founding partner of Again Capital and a CNBC contributor. Start off with number 1. So 1.5% of Aramco was sold. 1% was sort of pre-committed.
Yeah,
so about
that's a good word for it.
0.5% was actually available for purchase. Stock did well in Riyadh trading today. Are you surprised?
No.
Or is it success relatively a foregone conclusion?
I think success, it's state-sponsored success, in my view. And the way
they were, listen, 465% oversubscribed for the IPO. A lot more people wanted it than got it.
Which was kind of the kingdom to allow those folks to be off the hook. I mean, this thing's trading like lumber futures to me. You know, limit up, could go limit up for the next several days before it starts going limit down.
You don't need that. It's just me.
Okay.
Just you and I, John. Just 2 guys talking about 3 oil stories.
Right. And, but look, you know, the valuation, you know, wasn't pulled out of thin air by the global investment banks, right? We know the Saudi reserve number. We know their capacity. You can kind of get an idea of what the supply-demand balance is going forward. There is going to be energy, crude oil demand growth, maybe not as spectacular as it used to be. So you can kind of come up with the number. I think the number was reasonable. When you look at all the other oil companies in the sector, their peers, right, even though they're the biggest one, except for the one thing that you put your finger on in Vienna that I heard, which is the Saudi competitive advantage of having the lowest cost by far.
Well, thank you for watching, by the way. And you know what? I'd asked the Saudi energy minister in that press conference, and he was kind of quiet and reserved until then. And when I brought up the Aramco IPO, he kind of got really sort of went on like a 3-minute sort of speech, if you will. And we talked about their $2.80 per barrel production cost. I mean, you've got American producers who are probably not profitable or break even at 50 a barrel, 45 a barrel. They're profitable at 280. Why wouldn't investors be interested?
There's definitely a guaranteed cash flow. Again, what's the forward valuation though? And you know, it's gotten skewed by this hyper low float. And the other issues. There is sort of a heads I win, tails you lose component to the offering too. The way the state sort of dips its hand in to the pot when prices go or potentially go much higher, and also to what the investors will.
Well, their tax rate goes up. If oil's above 70, their tax rate goes up to I think 40%. If the oil goes to 100, the tax rate on that is 80%. So just be mindful. If prices go up, their tax rate on Aramco goes up.
Heads I win, tails you lose.
Perfect. So let's move on to topic 2, which is Chevron. $10 billion write-down, saying they're going to divest Appalachian oil and gas assets, this LNG thing up in British Columbia. Is Michael Worth, the CEO, effectively saying oil's not going to go meaningfully higher in the next quarters, months, years?
I think they have a dour outlook for sure. I'll tell you this though, Brian, over the years, look, oil is a boom and bust type of commodity for sure. We've had great times, we've had terrible times. When the majors do this, when they have a bad earnings quarter where they throw the kitchen sink at you in terms of writing things down or doing what Chevron's doing here, usually marks the bottom. So I would tell...
They're giving up. They're flushing out the assets that they don't believe are profitable, maybe at any price.
They've capitulated at this point effectively. So it may be worth investors finally looking at it. I think we're all trying to see if oil can make a comeback here in any way, shape, or form. This is a signal or a sign of that historically.
Yeah. You know, Anadarko's lost $20 billion in market cap since it agreed to buy Anadarko. Occidental has, rather. $20 billion in market cap. The market cap loss from Occidental is bigger than most oil and gas companies.
It's remarkable. And to go back to the Aramco surge today, I think that's the gain alone was bigger than the entire U.S.
At some point, there's going to be value, though, because Occidental's price dollar enterprise value per barrel is by far the highest in the industry.
That's the bankruptcies will fix that. I always say,
and they're coming. By the way, they're going to come.
The stuff isn't going anywhere. The rigs will be there. The oil will be there. The processes will be there. They're going to be picked up on the
stock. Many of these stocks won't be there. There'll be a different ticker or no ticker at all. Topic 3 quickly. We're supposed to get an inventory drawdown of I think 800,000 barrels. Instead, we got an inventory build of 3 million. There is so much oil out there.
There is, and there's also
oversupply,
and there's also a lot of pressure on the industry, including the refining industry. There was a sizable downtick in refinery operations in this week's report. That was surprising for the time of year. Also,
well, we do have this. I don't know. It's wonky. This IMO 2020 ship fuel sulfur regulations changed, so all these refineries are sort of changing their blends because now ships on the ocean have to use a different type of diesel.
Right.
So it's causing everybody kind of go haywire.
Although that market is fairly well supplied, the panic It could turn out to be the Y2K of this year for the oil industry, in fact, because it's much more of a scare than it's turning out to be. Fingers crossed.
That's appropriate because the U.S. oil and gas industry may need some rebooting.
For sure.
John Kilduff, thank you very much.
Thanks, Brian.
All right, coming up, Lululemon may be looking a bit like fruit of the loom, going after the male market. What the company is reportedly doing to woo its fastest growing customer base. All this with earnings on deck after the bell. Plus, the FAA not on the same page with Boeing on when the 737 MAX could get recertified. We're going to have the very latest from the FAA administrator who faces lawmakers on Capitol Hill. Phil LeBeau is up with that important story on maybe the most important stock in the world. Stick around.
Deeper data at CNBC. Total shipments through the Port of Long Beach dipped 2.4% in October compared to the same month a year ago, as tariffs impact international trade. Lower inbound shipments outweighed higher outbound shipments.
So, ServiceNow put your workflows in the cloud.
From ESPN and the award-winning producers of The Sterling Affairs comes the latest season of 30 for 30 podcasts. 4 brand new stories of espionage.
He wanted this team to be the Barcelona of women's basketball.
Resilience.
I started to scream. I tried to get away.
Corruption.
It's the culture of win at all costs.
And rebirth.
How will we ever rebuild it?
30 for 30 podcasts, season 6. Listen now to 30 for 30 podcasts on TuneIn.
Don't want to miss a second of your NFL team's next matchup? Let TuneIn remind you. Just make sure notifications are enabled on your phone and search for your team profile on the TuneIn app. Then, find the game you want under events and tap Notify Me. We'll send you an alert as soon as live coverage begins.
The puck drops. 12 players face off to win. The suspense is pure torture, but you wouldn't miss this for the world. TuneIn brings you every minute of the NHL season. Listen live to hockey when it matters most on TuneIn.
Like what you're listening to? Want to make getting back to it easier? Use the favorite button to keep track of the stations and podcasts you love on TuneIn. Just tap or click the heart icon to add it to your favorites. Then find all your go-to audio under the favorites tab. Pretty easy, right?
To LeBron, slam dunk. The NBA is on TuneIn Premium. Each week, TuneIn picks an NBA game you just can't miss. The Miami Heat are taking their talents to Texas to take on the second-year phenom, Luka Doncic, and the Dallas Mavericks.
Back trying to make it 11-2.
This Saturday, the Miami Heat are at the Dallas Mavericks. Tip-off is at 8:30 p.m. Eastern. Search NBA on TuneIn to follow your favorite NBA team today.
In the stock market and in life, everything can change from 1 minute to the next. Be the first to hear the latest money news and market trends with CNBC on TuneIn. Wherever your day takes you, listen to CNBC's full slate of programming, including shows like Fast Money, Squawk Box, and Mad Money with Jim Cramer. And when the next big business story breaks, CNBC lets you know with live updates and commentary. At the office, at home, or on the go. Search CNBC on TuneIn to listen.
And welcome back to the exchange. Here are some of the individual stock movers right now, retail edition. First, the Children's Place, getting a major timeout. Shares down nearly 23%. A revenue miss, disappointing comparable sales. The reason the retailer also cutting its full-year guidance. That stock is just hit hard. All right, number 2, shares of American Eagle Outfitters. They're down, not nearly as much. They're down 6%, though. This on weaker than expected holiday quarter earnings forecast. And finally, you seeing a trend here? Shares of Home Depot. They're down about 2%, so not as bad. Also, though, on a disappointing sales forecast for next year, HD says its One Home Depot strategy is simply not generating as much revenue as it had expected. All right, let's now get a CNBC News update. We'll go to Sue Herrera for that. Sue.
Hello, Brian. Great to see you. Here's what's happening at this hour, everyone. Money diverted from the Defense Department cannot be used to build a U.S.-Mexico border wall. That is the ruling from a federal judge who blocked the spending measure. More than $3.5 billion of military money had been earmarked by the Trump administration. The Justice Department says it plans to appeal. Search crews are combing the Antarctic for a Chilean military transport plane that vanished en route to a base on the frozen continent. The C-130 Hercules carried 17 crew members and 21 passengers, including 3 civilians. Bass Pro Shops is recalling a popular propane gas grill. The recall involves 4 and 5 burner models of Mr. Steak gas patio grills. The problem involves the grill's fuel gauge and the fuel line. The gas regulator hose can melt and potentially start a fire. And Greta Thunberg says that she was a bit surprised to be named Times Person of the Year. Leaving a UN climate conference in Madrid, Thunberg says she wants to dedicate the award to all young activists. She says she hopes that their message on climate change is finally getting through. You are up to date. That's the news update this hour. Brian, I'll send it back to you.
All right, Sue, thank you very much, and good to see you as well. So here's what else is coming up on the exchange.
Coming up, a real bullish call for the real. Free food isn't enough for workers at Google anymore. Monopolies aren't always bad. At least that's what Tim Cook says. And the FAA gives Boeing a reality check. That's all ahead on the exchange.
On 3, our unlimited data is actually unlimited. Like for reals. None of this, we're so unlimited, but you can't watch your fave Christmas film endlessly, or dead scroll inspo for tree decorations until 4 in the morning. We wouldn't do that to you.
We have no speed limits, no data caps, and you'll be 5G ready at no extra cost.
Ho, ho, ho.
Switch to 3, in-store or online. See 3.co.uk/unlimited-data.
This week at Tesco, whole beef roasting joints and whole legs of lamb are half price. That's a whole lot of halves off a whole lot of wholes. What a mouthful. Tesco, delivering Christmas for 100 years. Max 2 per customer, selected stores, excludes Express, ends 31st of December.
The swagger of a perfect dunk. The rush of a 3 made from all the way downtown. The adrenaline surge of great defense. Can you feel the goosebumps yet? There's nothing like live NBA and nothing like listening live on TuneIn.
Giannis down the lane of the rim, going right corner 3, another one.
TuneIn Premium brings you every minute of the NBA season, so you can be there when it matters most. Never miss the action as it happens. Hear the ball you love. Hear it live on TuneIn. Search NBA today to start listening.
Want to know a quick, easy way to see if your favorite podcasts have a new episode available? Just go to the home screen on your TuneIn app and see the latest editions under the Your New Episode section. Happy listening.
Cutting for the net, scores! Along the goal line, Marchand scores!
Hockey fans, the 2019-20 NHL season is here.
And tucks it home!
And with this team, it's really fun to be a part of a team like that.
And you can hear the action live on TuneIn Premium. From regular season action to the All-Star Game and through the Stanley Cup in June. Hear the home and away call for every game, for every team live. At home or on the go, never miss a game with the NHL on TuneIn Premium.
Upgrade today.
When you're not listening to your team, take it to the end zone, the rim, or the net. Keep up with the biggest moments in sports by following TuneIn on social media.
Block, Cook into the end zone for the touchdown.
From reminders of the live top games to tips of the best sports stations and podcasts.
Welcome to Undisputed. We are live from Los Angeles. I'm Jenny Taft here with Skip Bayless.
Follow at TuneIn on Facebook, Twitter, and Instagram to get the most out of TuneIn.
Ah, finally another commercial, said no one ever. Visit TuneIn.com/premium to upgrade now and get over 45 commercial-free music stations.
All right, welcome back. Keeping it real, the best places to work, and maybe the worst. And Lululemon wants to sell Dominic Chu pants. Some of the hot topics in today's Rapid Fire here with their hot takes. R.C. Mamodi, Dominic Chu, and Kate Rogers. Y'all ready?
Yeah.
Y'all ready for this?
Let's do it.
I think. All right, first up, I'm old. D.A. Davidson is initiating coverage of The Real Real with a real buy rating. Now, The Real Real is an online consignment shop. Basically, you send them your clothes, either new or old. They pick out the stuff that they may or want to sell to somebody else. They give it back to you what they don't, and then they sell the good stuff, hopefully, and you make some money. The analyst says the company has several first-mover competitive advantage in the large and fast-growing market of luxury resale. However, that stock is down 14% since the June IPO. The analyst price target, though, of 22 represents 33 upside from here. Of course, Simo Modi, that's on a declining stock. Is The Real Real for real?
That is the key question. Our CNBC investigations team had a big story that
Did a
came
real
out just
deep
a
dive
couple
into
weeks
it, and
ago
yeah,
that
they
found
didn't
that
like
this
it.
authentication process needs some, there is some room for improvement there. But if you take a step back and look at the retail landscape, Brian, high-end luxury retail has consistently performed well over the last 2 to 3 quarters. We cover names like LVMH carrying as part of our European close. All those luxury names in Europe are up about 35% or more this year. So the idea here is that there seems to be an opportunity for Real to be the secondhand marketplace for the younger consumer that wants to own luxury handbags but doesn't want to pay full price.
But here's the catch, right? She mentions LVMH, you mentioned Kering, you mentioned names on the luxury side here. Those are names that can possibly be really disrupted by what's happening with RealReal, Poshmark, all these other ones, because they sell new products to consumers. That's how they make their money.
But they don't have to be new. I mean, they could be like you wore it a couple times.
LVMH, let's say let's say you want a Louis Vuitton bag. Let's say you're in the market for that. You can go to Louis Vuitton and buy. It's a big bag, right? It's a very expensive one. Or you can go to one of these sites and maybe get a real one. There's obviously some questions about that. But re-commerce, that's this whole concept of secondhand selling. That is a disruptive force right now because these folks who sell new products are not.
But don't discount the power of our investigation. Seema brought up because let's say a Birkin bag, which I've heard about, right? These Birkin bag, whatever. They go like 20 grand.
Birkin may be the one.
Actually, at the country club right here, they had a wine issue with a woman. You hear about that? It spilled. She's suing the waiter. Everything's a disaster. Anyway, those go for like $20,000. Let's say somebody puts it on the RealReal and says this is a real one, and it's $5,000, which sounds it's expensive compared. And then you get it and you realize it's fake. If they don't have the trust of the consumer, I'm not sure what they've got.
That's what I was going to bring up. I mean, does the authentication process get better from here? They said they have room to improve. They need to work on that. But does the consumer continue to trust them? And is this total addressable market really as big?
Well, how do you do that? I mean, do you have that many experts? They can literally go in and inspect every single thing.
They get 30 hours of training.
You start getting a lot of these fakes on there.
There's checkpoints they can do. So there is certainly an opportunity here for RealReal to establish more credibility with their customer.
There you go. Platform goes down if the reputation goes with it.
There you go, Dom. Well said. All right, topic number 2. Is your workplace nice or not? Glassdoor is out with this list of the best places to work in 2020, and needless to say, technology's troubles continue to grow. Facebook, which, by the way, claimed the title of the best place to work just 3 short years ago, fell 16 spots on the list. It is now 23rd. Google dropped 3 spots to number 11. Apple fell 13 spots to 84.
Number 1.
Yeah, well, listen, despite the stocks going up, the employees don't seem to care. There's a lot of social issues at these companies. There's protests outside their own organizations.
So big tech is under fire. Big tech will continue to be under fire as long as the current administration and current kind of legislative scheme in Washington holds the way it is. That's one of the reasons why PR is a bad thing here. But the companies that do top the list are always the ones that give out the big perks. Remember when Facebook had it, it was a lot of the scheduling, time off type things. HubSpot, which is the number 1 on the list this year for Glassdoor.
That's an interesting story unto itself.
It's a cloud computing company.
I know it, Boston
smaller,
based.
exactly right. But it has unlimited vacation. There's all these different perks that go along with it. It's a tight job market, and those kinds of companies stand out. Remember a time when Alphabet/Google let you bring your pets to work? That was a big perk at one point.
But listen,
they paid for food.
Read Mike Isaac's book, Super Pumped, about Uber. And he talks in the book about how Uber employees, it was so hot, they would wear Uber hats and Uber shirts and Uber. And then all these bad things started coming out about Travis Kalanick and the company. Everybody was embarrassed. They hid their Uber merchandise. I wonder, Kate, if the same thing is happening with like a Facebook, given the Cambridge Analytica and everything. People say, you work for Facebook? That's the new gold standard. You throw the stuff in the garbage.
I don't think you can discount how much that's impacting the company. But when I was reading about it, they also said there's a lot of pressure inside the company to fix the outside issues. So the work-life balance, for example, is not what it used to be, and that helps it fall lower and lower on the list because the company culture is changing.
Yeah, and it was interesting to see some of the complaints that were made as to why they don't love working at Facebook. Bureaucracy, a lot of politics amongst their leadership. It kind of reminded me of the type of complaints that you would attach to a larger legacy traditional firm like an IBM, if you will. But it's a good point to remind everyone that Facebook was founded in 2004. It is no longer a cutting-edge startup that is, a Silicon Valley private company. Went public in 2012. It's been around for a while. style.
That's a perfect point. And listen, all the young people out there got to remember, when companies get gigantic, bureaucracy occurs. It doesn't matter what your industry, how cool you are. If there's dogs and free beer, it's going to get, and there's going to be infighting. That's the way it is. All right, next up, perfect segue for Dom: stretchy pants for men. Lululemon doubling down on its efforts to attract male consumers. The retailer saying the segment is growing faster than its women's division and accounted for more than 21% of its sales last year. And the stock really flexing its muscle. Look at that. Lulu Dom has nearly doubled this year, while its competitors, who've done okay, have not nearly performed as well as Lulu.
So the trend is your friend here. Athleisure has been one of those kind of movements that we've seen for men and women that have been in play for months, if not years at this stage. Lulu is at the forefront of it. Now, Lulu has a first mover advantage with regard to those types of products, but now there are so many other companies that are coming in and kind of creeping in on their territory. And we're not talking massive brands like Nike or Adidas. We're talking about niche brands out there. I remember this season I've bought pants from a company called Rhone, which is a startup athletic apparel maker. Okay. I've got them from Western Rise, which is another...
For men or is this a gift for your wife?
These are technical pants that you can wear to work, commuter type pants.
What's a technical pants?
I mean, it's the fabric that's stretchy.
Plug it in?
Away.
Charge it?
Yes.
Looks like slacks,
looks like
feels like
yes.
sweat.
It's
That's
the Joe
drape
Kernan-
yourself
it's
in
the Joe
velvet?
Kernan
I can
pant.
drape myself in velvet.
But it's not velvet, though. It's like four-way stretchy pants that make that look like dress pants.
Yeah. Great for
but
airplane
act
rides.
like
Can we just, Seema, end the term athleisure? It's an oxymoron. I came up with a better term. Because
Oh,
what do you want to do, really? You want to wear it while sitting on the couch, eating stuff, but still look good. Let's call it Lays-tastic.
Ooh,
Wow.
I like it.
You like that?
That could certainly
Athleisure's
I have a
out.
feeling Lululemon's going to be calling you. For sure.
It's not a Lulu. They don't own me. You know.
No, I mean,
can
it's
sit
a
on the
great
couch.
idea. Lays-tastic.
Lays-tastic.
Yeah,
You
I'm
like
saying
it?
to work with you. To
Do
team
I
up for
look
this.
Lays-tastic?
Totally.
Do you remember that acronym MAMIL? M-A-M-I-L? Middle-aged men in Lycra.
Oh, gosh.
MAMIL,
Wow.
M-A-M-I-L.
That is another
That was a thing for
That's
a while.
a visual.
Yeah, exactly.
Anyways, I think tonight will be a big moment for Lululemon. As you say, it's up 91%. Earnings will really show us whether this whole marketing strategy to attract more men is actually working despite a very
You
crowded
bringing back the
marketplace.
sanity on the
No,
show.
and
By
I
the way,
will
the
just
earnings
say-
will have Fast Money 5.
Oh, yeah.
You'll see me again.
You'll be there.
I'll be there.
And Calvin McDonald says they don't need to discount these. They're $128. Some go as high as
Or more.
$200, which is really interesting. The
You got
CEO says they're
pricing
still
power.
in growth, you know?
You got everything these
That's right.
days because it's rare. Topic 4. Apple CEO Tim Cook making some controversial comments in the Nikkei Asian Review, Japanese paper, saying, quote, "A monopoly by itself isn't bad if it's not abused." He went on to say, quote, "The question for those companies is, do they abuse it? And that is for regulators to decide." Shares of Apple, meantime, hitting another all-time high. Kate Rogers, he's clearly not talking about himself.
No, and I think in this article you can sense Tim Cook's frustration with being lumped in with other tech companies, like the Googles of the world, like the Facebooks of the world, Amazon. He's like very frustrated. He's talking about them, and I think the issue that people are lumping big tech all in one group, and he's saying, we don't monetize your data that way. This isn't what we're doing. We're different. I think it's an interesting comment, and I'm not sure that people will necessarily agree, but he also says Apple's not a monopoly.
That's
Well, they are in certain parts,
Yeah,
right?
are they not?
Yeah, so they're certainly not in smartphones. If you look globally, their smartphone share is not anywhere near places like Samsung or any other.
But it's App Store.
But
That's
an App
the
Store,
issue.
App
And
Store
it's
is the
faced
issue,
a
right?
number of anti-competitive
iTunes, music, and
complaints.
that sort of things. That's where it becomes an issue. But I would say this. I mean, regulators will always have to be there to determine whether companies are violating those particular practices.
I'm
So
going to dust off the old law book, though. Remember this. Monopolies are not de facto illegal. A monopoly is only illegal when you use it to either tie
your
it
power,
to,
yes.
tie it to another product or block a competitor. I don't think Apple does either of those things.
Yeah, we'll have to see. But of course, Tim Cook has to hold that stance that bigger is better and that they are not a monopoly. And even if they look at the App Store, they're sticking to the rules and allowing regulators to play the role that they're supposed to play. But they have, this comes amid rising concerns about the anti-competitive behavior.
Yeah.
That
Although I do wonder this, I'll ask our viewers this: if you haven't had an iPhone, or by the way, the Samsung, the Google phone, if you've had a brand of phone for 5 or 10 years and you bought all this music, which comes in a file format that doesn't work in other formats, and have all the photos, are you ever switching? Are you ever switching?
By
we
the
know
way,
the answer.
You just did Brooklyn Law really proud just now.
I
just wanna
know.
say
I
that.
barely passed.
I know, right?
Finally, Google is out with its top trending searches of 2019. Apparently, Dom has been Wikipediaing my education. And some of the results may surprise you. Let us start with the top trending searches. Okay, so top trending, what is movies also? So what is Disney Plus? Who is Cameron Boyce? And who is Nipsey Hussle? Obviously, Cameron and Nipsey were tragic stories. They died too soon. So we'll move on from that. Disney Plus, though, that's got to be a win for Disney. Be the top trending search.
I was surprised to see that despite Netflix being out there having that first mover advantage, there was this much interest in Disney Plus. And of course, there are numbers to show that there is strong demand, but we'll have to see with earnings if it's enough.
I think it's all of these parents wondering when this is available, what movies are going to be on there, because we've talked about the competition between obviously Disney Plus and Netflix and how much children's content Disney Plus has, and also all the Star Wars stuff, which we all know.
Marvel.
I don't watch Marvel, but we know that's your territory.
I love it.
So I think that there's dual interest there.
We have to
parents,
answer that. Remember the riddle at the top of the show?
Yes.
What do Area 51, Disney Plus, and like Sri Lanka have in common?
They're all top trending
They are.
searches.
So look at these top trending searches. What is Area 51? It's where the aliens live. We all know that. What's a Visco girl? What is Momo? I don't know what that is either. What is
a boomer?
What is a boomer, which we know now is sort of an insult to older people. And what is quid pro quo?
So, by the way,
which goes away, by the way, to the Trump-Ukraine investigation.
Yes.
I wondered at first why that was on there. Then I'm like,
But this is also, remember, when they say trending searches, this is not necessarily the most searched item. This is the biggest spike in traffic over the same time last year. So it's because Disney Plus didn't really exist last year, right? And all of a sudden there was all of this interest, so it's a trending search. By the way, guys, you know who the #1 person that was trending on Google was this past 2019? You know.
I know, but go ahead.
Carl Quintanilla?
No. It's close, though. It's Antonio Brown, the most trending person on the Google search in 2019.
Yeah, all in the Boston area.
Yes.
Seema, Dom, Kate, thank you very much.
You're very welcome.
Have a lovely day.
You too.
The FAA administrator testified on Capitol Hill today about the agency's relationship with Boeing. It is a big story and an important stock, and we'll get the latest from D.C. next.
Hey, NFL fan, can't watch the game? Can't be there? No biggie. With your TuneIn Premium membership, you already have an all-access pass to every team and every game in the league. Amazing, right?
Steps up, floats it towards, at the goal line, it's intercepted!
Listen live as the action unfolds or on demand when you can. Anytime, anywhere, all season long.
Right side, it is caught, it is in for the right side for the touchdown.
Search NFL today. Don't want to miss a second of your NFL team's next matchup? Let TuneIn remind you. Just make sure notifications are enabled on your phone and search for your team profile on the TuneIn app. Then, find the game you want under events and tap Notify Me. We'll send you an alert as soon as live coverage begins. Hey, NFL fan, can't watch the game? Can't be there? We've got you covered. With TuneIn Premium, you can listen to every NFL game live as it's happening.
LaShawn McCoy has an opening on the right side, punches into the end zone for the touchdown.
Or catch it later on demand.
Offset backs behind Mahomes. The give is to Williams. Starts right, cuts it back to the left, and flows into the end zone for the touchdown.
You call the plays. Follow the NFL anytime, anywhere, all season long with TuneIn Premium. Upgrade today.
Hey, tune in listeners. Steve Kornacki here from NBC News. I want to tell you about a podcast I'm hosting called Article 2, Inside Impeachment. It's dedicated to bringing you the latest developments on the impeachment inquiry into President Trump. Every Monday, Wednesday, and Friday, I talk to NBC News reporters who are closest to the story to break down what's new, what matters, and what it means for the 2020 election. Search and favorite Article 2, Inside Impeachment on TuneIn.
Are you curious what others are listening to on TuneIn? Head to the trending section under Browse to see the most popular stations and podcasts among TuneIn listeners right now. Check it out. You might just discover something new for yourself.
FAA Administrator Steve Dixon testifying on Capitol Hill today. It's all regarding the agency's relationship with Boeing and its oversight with the 737 MAX. Phil LeBeau is in D.C. and has more. Phil.
Brian, during a 3-hour testimony, the head of the FAA was pressed about the FAA being lax when it comes to safety issues involving the 737 MAX, as well as Boeing's plant for the MAX out in Renton, Washington. Listen to this exchange between one representative accusing the FAA of ignoring the complaints of a Boeing whistleblower.
I know you knew that he wrote to you, that Mr. Pearson wrote to you once in September, but in fact he wrote to you 3 times, sir. He wrote to you in September, he wrote to you in October, and he wrote to you in November. And I know you just got on the job, but he didn't just write you letters. He sent you extensive information, didn't he, sir?
Yes.
on production problems that he identified at the Renton facility.
Yes.
So my question to you is, have you interviewed Mr. Pearson?
We have reached out to Mr. Pearson to schedule.
That's not my question. Have you interviewed him?
I know that we have contacted him. Yes.
So
I don't know if
excuse me. He's sitting right over there. Okay. Will you commit, as we sit here today, that you will interview Mr. Pearson?
Absolutely.
Will you investigate the production problems at the Renton facility?
Yes.
Can't say that word mistake, huh?
Well,
that one's just sticking on your lips there.
I don't want to blame other. I don't. Again,
not about blame, sir. It's about accountability. We're not trying to.
Okay. Again, I'm accountable. Okay. So I hold myself accountable.
Can you say that the FAA made a mistake in not taking seriously Mr. Pearson's concerns in a timely way?
We are taking all concerns, any concerns that are raised, we are going to take seriously and run them to ground in a systematic way so that we can make the right decisions.
Just a taste from 3 hours of testimony for FAA Administrator Steve Dixon today. As you take a look at shares of Boeing, they're off of the low of the day. But, Brian, we should point out that this is a stock that went down earlier today because the FAA came out and said it ain't going to be certified. The 737 MAX is not going to be certified before the end of the year. That runs counter to what Boeing has been saying all along, that it still expects certification by the end of the year. Brian, back to you.
Well, Phil, just quickly, why is Boeing saying anything? It's not their call. It's like me saying something about what someone else may or may not do. It seems a little bit, I don't know, irresponsible in some levels.
That has been the question that has been asked ever since they put out this timeline on November 11th. Remember, that's when they said we expect certification by the end of the year and potentially some airlines to return to commercial service by the end of January. Remember after that came out, Brian, there was a couple of statements and then a video email that Steve Dixon sent out to the representatives at the FAA saying, we call the time. They don't determine it. We call the time. They don't release those video emails, Brian, voluntarily every week when he addresses employees. That was a clear signal from the FAA that they are tired of Boeing trying to pressure them in terms of getting this plane recertified.
All right, Phil LeBeau in D.C. Phil, a real pleasure, an important story there. Thank you very much. All right, well, don't lose sight of this. The Fed rate decision is now just a few moments away, and Jay Powell and company are in a very different situation than they were 1 year ago. We'll take a look at what is ahead and what has changed.
As a principal, I can tell you this.
We can't make traffic move faster during rush hour. But we can help you catch up on the news with TuneIn. With live around-the-clock news from MSNBC.
In the UK, they're significantly worse. When the president gets up to the podium...
CNBC and Fox News Talk.
The Fox News poll sizing up the race for 2020 found that each of the 5 top Democrats...
You can use your stop and go for good by staying in touch with the world. Search news to hear what's happening now.
Want to hear about the latest and greatest things to listen to on TuneIn? For reminders of the biggest live sports games, debates, and breaking news stories, follow @TuneIn on Facebook, Twitter, and Instagram to stay connected with the audio that matters to you.
The swagger of a perfect dunk. The rush of a three made from all the way downtown. The adrenaline surge of great defense. Can you feel the goosebumps yet? There's nothing like live NBA and nothing like listening live on TuneIn.
Giannis down the lane of the rim, throwing right corner three. Another
TuneIn Premium brings you every minute of the NBA season so you can be there when it matters most. Never miss the action as it happens. Hear the ball you love. Hear it live on TuneIn. Search NBA today to start listening.
This is not a commercial. This is a reminder. With TuneIn Premium, you could be listening to more music commercial-free. Get over 45 commercial-free music stations. Visit TuneIn.com/premium to upgrade.
Cutting for the net, scores! On the goal line, Marchand scores!
Hockey fans, the 2019-20 NHL season is here.
And tucks it home!
And with this team, it's really fun to be a part of a team like that.
And you can hear the action live on TuneIn Premium. From regular season action to the All-Star Game and through the Stanley Cup in June. Hear the home and away call for every game, for every team live. At home or on the go, never miss a game with the NHL on TuneIn Premium.
Upgrade today.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
Hey, NFL fan, can't watch the game? Can't be there? No biggie. With your TuneIn Premium membership, you already have an all-access pass to every team and every game in the league. Amazing, right?
Steps up, floats it towards, at the goal line, it's intercepted!
Listen live as the action unfolds or on demand when you can. Anytime, anywhere, all season long.
Right side, it is caught, it is in for the right side for the touchdown to Keenan.
Search NFL today.
We are just 10 minutes away from the Federal Reserve's latest interest rate decision. Is there a risk for a repeat of last year's December sell-off? By the way, the worst December, Bob Pisani, since 1931. How quickly we forget.
It was awful. So this is a very, very different Federal Reserve, different situation, really. Now, remember last year we did this, and Brian, it was a little later, this meeting, it was December 19th last year, and here's the S&P for December. As Brian said, this was depressing the whole month, but here it is. They raised rates. That was the fourth time they raised rates on the year, and the market dropped, the S&P dropped 1.5%. Not only to drop that day, but for the following couple of days, it continued to drop. The month did not start out well, of course. Here's December 4th. Remember, President Trump described himself as tariff man, now famous phrase. Well, the market dropped 1.5%. And as you can see, we just kept slowly sliding into it until we eventually bottomed, as Brian referenced, the worst Christmas Eve ever, at least in my memory down here. So we had the Fed, we had concerns about trade, and of course we had a looming government shutdown too. That was also a little bit of a factor in this horrible, horrible December. And again, very different. If you look at the S&P, I mean, we're not done here, but very, very different S&P for the month of December so far. Here we are, beginning of December. Essentially, we're flattish for the month. Now, remember, last time, December, we were looking in this direction. So we were down about 5% this time in December of last year. Now we're essentially flat. So it's a lot better situation. Remember, though, we do have, Brian, the tariff deadline looming on December 15th. So we can't exactly say what's going to happen. But so far, very, very different situation. Brian, back to you.
Yeah, if those tariffs hit Monday, could be very interesting. Bob Pisani, we'll see you in the Fed decision. Thank you very much.
Okay.
All right, by the way, that Fed call now just a few minutes away. I will see you on Power Lunch as well with Contessa Brewer after the break. We got the Fed. We've got a great panel. A lot more to do. We're back right after this.
Hockey fans, the 2019-20 NHL season is here.
Here's Pietrangelo, he scores!
And you can hear the action live on TuneIn Premium.
The move, and a shot, he scores!
From regular season action to the All-Star Game and through the Stanley Cup in June. Hear the home and away call for every game, for every team live. At home or on the go, never miss a game with the NHL on TuneIn Premium.
Upgrade today.
Introducing a new podcast, ESPN Daily. When you want to go beyond your feed, when you want to get inside the score, when you want to get behind the highlight, there's ESPN Daily. Go deeper into the stories of the moment. Get the exclusive access and insider perspective that only ESPN can give you. ESPN Daily, hosted by me, Mina Kimes. Listen and favorite ESPN Daily on TuneIn.
Did you know your favorite radio stations are in your pocket? Yes, the TuneIn app lets you listen to the same radio stations you pick up on your home or car radio anywhere you want. To see all the stations broadcasting in your area, find the local radio section on the home screen. Keep it local with TuneIn.
Hey, NFL fan, can't watch the game? Can't be there? No biggie. With your TuneIn Premium membership, you already have an all-access pass to every team and every game in the league. Amazing, right?
Steps up, floats it towards, at the goal line, it's intercepted!
Listen live as the action unfolds or on demand when you can. Anytime, anywhere, all season long.
Right side, it is caught, it is in for the right side for the touchdown to Keenan.
Search NFL today.
We can't make traffic move faster during rush hour, but we can help you catch up on the news with TuneIn. with live around-the-clock news from MSNBC.
In the UK, they're significantly worse. When the president gets up to the podium,
CNBC and Fox News Talk.
The Fox News poll sizing up the race for 2020 found that each of the 5 top Democrats.
You can use your stop and go for good by staying in touch with the world. Search news to hear what's happening now.
Want to hear about the latest and greatest things to listen to on TuneIn? For reminders of the biggest live sports games, debates, and breaking news stories, follow @TuneIn on Facebook, Twitter, and Instagram to stay connected with the audio that matters to you.
Welcome to Power Lunch. We are just minutes away from the Federal Reserve's decision on interest rates. And as we await the decision, the markets right now are mixed. The Dow slightly lower, while the NASDAQ and S&P are in the green, but just barely. Jim Karen is Global Fixed Income Portfolio Manager with Morgan Stanley Investment Management. Mona Mahajan is a U.S. investment strategist with Allianz Global Investors. And David Kelly's Chief Global Strategist with J.P. Morgan Funds. It's good to have you all here. First of all, Jim, can we talk a little bit about what you're expecting out of this decision?
Look, I don't think there's anything that's going to be earth-shattering. You know, his last statement was that the economy's in a good place and it would take a material reassessment to adjust the view. I don't think that really changes. There might be an update to the unemployment rate that probably bring that down from 3.7 to 3.5. I still think that it's, that the Fed's going to keep their upward bias in their policy rates going into the out years. So, look, I mean, I don't want to make this sound like a boring meeting because I don't think it will be. I think what's going to be much more important is going to be the press conference and how he decides to construct his communication strategy for 2020. And I don't think enough people are talking about that.
We have been talking a lot about whether we should put a bet down on whether he uses the economy's in a good place. Those 3 special words we've heard over and over again. Mona, what's your expectation for any drama coming out of the, not just the meeting, but the press conference as well?
Yeah, we're calling this a drama-free meeting, so I do think there'll be
thanks for coming on, Mona.
That's it. Time to head home. No, I think, I do think no rate cut or rate hike. I do think they will talk about how they're going to stabilize the repo market. They're very vigilant on that front. I also think they will talk about the risks globally, not only trade, but global growth slowing. And in the U.S., we're still getting that manufacturing softness. So it's that dichotomy between manufacturing and the consumer economy still there.
David, I think, Mona, you are correct from a rate perspective.
From a rate perspective.
But you look at what else the Fed is dealing with this trade fight, the possibilities of a bunch more tariffs in a couple of days, maybe tariffs on a couple $2 billion in European goods as well, an election, Brexit. There's a lot of stuff I would imagine they're going to be dissecting and discussing that we won't maybe hear about today.
Exactly, internally, because the message they want to send is, we're on vacation, guys. We're going to be on vacation all of 2020. Please don't expect anything from us because we really don't see, maybe in retrospect, we shouldn't have cut rates and, if the market's up 30% this year, maybe they shouldn't have cut rates, but from here, they really don't want to do anything in an election year unless they have to. And so I think that's really going to be their message.
Right now, we just got this CNBC Fed survey back that said 57% of those who responded think that they will actually cut rates again by June. That was the average forecast next year, 57%. And yet we're seeing continued job growth. We're seeing a very modest rise in consumer prices. Tell me what the market sees that the Fed's not seeing, or are they?
Yeah, the market may be looking at the Fed funds futures market and not realizing that that's somewhat distorted here. But the key thing is, when you look at the wages of production non-supervisory workers, they're up 3.7% year over year. That is the strongest we've seen in this expansion. If wage growth is rising, there is no reason for the Fed to be cutting.
We got 2 minutes. Let's go around the horn, play a little game. You ready, Contessa? This is the last Fed meeting of the decade. It's kind of cool to think about that. So, will the first rate move, David, of the next decade be a hike or be a cut?
It'll be a cut because the economy is eventually going to run out of steam and threaten recession again, and that's going to, I think, lead to the Fed to cut.
Mona? And when?
I don't think until after the election. Maybe a year's time might well be appropriate in December.
Mona, hike or cut?
I'm going to go hike.
You're going hike?
Yeah, for the next move, but probably not
just to spite David, or just because that's what you believe?
I don't see a recession imminent on the horizon. I do agree that if we start going down that trajectory, all bets are off. But
I think it's a rate cut, and I think it's sometime late in 2021. I just think that, look, I mean, the economy...
almost 2 years before another Fed move of any kind?
Financial conditions are very, very easy. I don't see a recession in 2020. we may run the risk of then slowing down after the elections, and I think that could be the case where the Fed does start to have to cut again. And look, I think the market's fundamentally misunderstanding one thing. Interest rates are low, and we always get this. Why are rates so low and the equity market up so high? It's because the downside risk is so much bigger than the upside risk right now in the economy. So, for example, like we've got trade, we've got all these other things. We have a political election coming up in 2020. So the bet is that if bad things happen, that's going to be much worse than if good things actually happen. So, therefore, the market skews rates a little bit lower. I'm in the camp that I think we need to be cautious. I do think 2020 is going to be a decent year, but I do think that the next move is a rate cut, and it's 2021.
Well, we are heading into the Fed decision. We're going to find out in a few seconds. A good discussion there. We had two cuts and a hike. We've got a Dow that is barely moving down 27 points, but again, there could be a lot discussed. We're going to find out what they say about the economy, the strength of the job market, and inflation. So there may be more drama than we expect. Let's find out now. Let's go right now to Steve Leisman, who's in D.C. with the Fed decision on rates.
No change in the federal funds rate. The Fed funds rate remains in a range of 1.5 to 1.75%. The committee judges the current stance of policy to be, quote, appropriate. It was a unanimous decision, the first unanimous decision by the Federal Reserve by the Mark Committee since the April and May meetings. No dissents either way, that means. The median forecast no longer sees a rate hike in 2020. That had been built into the September forecast. We have a new forecast this year, this meeting, and there's no longer a rate hike built in. Some division over 2021 where several have multiple rate hikes built in. But only one is the median of 1.9%. The long run rate for the funds rate remains unchanged at 2.5%. Here's of the economy, very much the same as it was. In fact, I don't have any change at all. Labor market remains strong. Economic activity rising at a moderate rate. Job gains solid on average. Unemployment rate remained low, and I could go on. Business investment exports, the only weak spot there, and inflation running below the Fed's 2% target. The Fed continues to monitor global developments and muted inflationary pressures. So those two things very much animating Fed policy, very much on its radar there in terms of what is behind or motivating policy right now. Finally, a little bit on the unemployment rate. They lowered the unemployment rate forecast to 3.5% from 3.7%, and the long run rate actually down to 4.1. That's a sign that the Fed at the current rate is willing to tolerate a lower unemployment rate, and that's a number that, as you know, over the years has come down and down and down. Tyler?
I'll pick it up from here, Steve. You know how? No, it's okay. No, do not worry about it. Listen, man, you got your hands full there. I love these word counts. Back from the old days when I covered the Federal Reserve, Steve, I like to go in and compare the old statement to the new statement. Search for words like strength and expansion and inflation. They're all the exact same. I haven't been able to do it completely, Steve, but I wonder, is this statement almost or exactly the same as they literally just faxed it in.
Well, actually, it's quite a bit different, Sully. It's different in that this is a statement in which the Federal Reserve is signaling that it's on hold. It's from an economic point of view and how it's describing the economy, it is exactly the same as I reported. But what is different here is that the language you want to key in on is this language where it says the current stance of policy is appropriate. And appropriate for what? Appropriate to sustain the expansion and bring inflation back up to the 2%. So that's a new sort of term of art. It also uses that term. It will assess the appropriate path from the last statement. So description of economic activity, you're absolutely right, is exactly the same. But some new language, that's the new language where the Fed is signaling to the market. These are the new keywords that the market has to get used to, where the Fed is signaling it's on hold. And I think the word appropriate is one that is now one you should have at the top of your dictionary. And hey, it begins with A, so it shouldn't be that hard.
So, Steve, here's my question. Since the decision coming out of this is largely what you expected and what you told us we would hear yesterday, what will be the burning question that you want answered from the chairman?
I don't think my question this month is different from the question I would have asked last month, which is we continue to probe what the parameters are for a change in policy. I get a feeling here the Fed is hunkering down for being on hold for a while here. The chairman has used phrases like a material change to the outlook. He's talked about a significant rise in inflation. But I think we want to know how close the Fed is. So here's what we want to know, Contessa, and why we want to know it. What I want to know is when an unemployment rate comes in higher or lower, a jobs number comes in, a GDP number comes in, and I think this is what the market wants to know, and this is why we do these things to begin with, is when it comes in and we can't ask Powell a question, we want to know how he and the committee will react. It's called, in the term of art, is the reaction function, and we want to know how policy would function given a new piece of data. And so the questions are going to surround what would it take to change policy and come off of hold. And I think another question we have, Contessa, is about the repo rate and the extent to which the Federal Reserve feels like the repo market, the overnight lending market, is ready, and there's sufficient amounts of cash in there for the turn of the year, which is always a bumpy and rough ride when it comes to financial markets.
Okay, and I want to get to that repo issue shortly, but Mona, first, what should it take for the Fed to consider taking action?
Yeah, I think there's a couple things on the table there. One, we have U.S.-China trade, like we talked about, still out there. December 15th is still a key date. We don't know clarity or don't have clarity around that. And number two, it's interesting, since they last met, we've had this shift in market sentiment that perhaps we're in this bottoming process in the economy. Perhaps next year we'll see a mid-cycle reflationary story. And so I'm wondering if the Fed is also, alongside the rest of us, watching to see if the data proves that out. And I think that will be key. We talked about PMIs earlier. We'll be watching to see if those stabilize, not only in the U.S., but globally. So I think the Fed is watching the U.S. global economy trade just like the rest of us, and any material deterioration or appreciation will cause them to move.
Going back again to that CNBC Fed survey, we saw confidence in even a limited trade deal falling. It was 83% in September, 54% in December. How crucial is trade to what we will see unfold over the next year?
I think it's very crucial. And the problem is that I think the best we can hope for here is a fragile ceasefire rather than a durable peace. And that's really the problem, because global business is holding back on investing because they don't know what the rules are going to be around trade. And I think that the administration seems to think that, if the markets go up on rumors of a trade deal, that's a positive. I think the real positive is having some certainty around that. I think you have to get past the 2020 election for that. So I think that's going to be an anchor on both global interest rates, frankly, and on the global economy over the next year.
Well, if you look at these, go ahead, Scott.
I was just going to say, most people I talk to think that there's mostly downside risk on trade, in part because they think the damage that's been done to the economy from trade is already done, and the question is, does it become worse? The expectation that Contessa was talking about for a limited trade deal, most people I talk to don't think there's too much economic benefit of that other than eliminating downside risk, because a limited trade deal isn't going to get rid of the prior tariffs, is the thinking out there, and that means that the damage has been done for 2020, or at least the first half of it.
We've had those tariffs now for 2 years? I mean, at some point, when do you start thinking this is just the way things are? I mean, we can't just keep waiting. I mean, the definition of insanity is doing the same thing over and over again and hoping for a different outcome, Jim. I want to quickly get to the repo thing, because we talked about it just a little bit, and we've been digging into it. Some people think it's nothing. Some people, a couple people, think it could be everything. Where do you stand?
I stand closer to everything than nothing. It is something, for sure. I mean, liquidity in the markets and the proper market functioning, I think, is absolutely critical, and I think this is
a former Federal Reserve strategist who's now a strategist at Credit Suisse, named Zoltan Pozsar, put out a note effectively saying a couple days ago that it's going to spike yields and it's going to screw up the FX market, which is going to send stocks crashing.
Well, if things aren't addressed, that can certainly happen. But I'm glad,
it could.
Right. It could,
you agree those things could happen.
Without doubt.
Sort of the dominoes going dunk, 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 dunk.
Liquidity, it all starts in the repo market, right? If you can't get financing, which is the base rate of the market, that creates a problem. So that's what the financial crisis was all about, was really a loss of financing. But now let me talk about something here, because I want to change course a little bit. I'm very uncomfortable with this Fed statement, and even with the way that things are being addressed right now, because effectively what the Fed is saying is they're going to let the economy run hot. Okay, that sounds great, but I'm a fixed income investor. So what does that mean for me? Does that mean that we allow inflation expectations to move higher? Do we allow interest rates to move higher?
It means you're a wimp. That's what it means.
Oh, gosh.
And if fixed income investors have been wimps for a very long time, you do not ask for inflation compensation. You continue to buy U.S. bonds that trade at real negative rates, and you will take what you're given, I think, is what the U.S. government is saying and what's been happening here. The Fed, I think, is following the market on this. And I mean no disrespect, I'm just kidding around here. Yeah. The market has been taking down $1 trillion plus of U.S. debt at a negative real yield, not demanding inflation compensation. The Fed has followed this, and the idea is that it doesn't see the inflation out there. Neither apparently does the fixed income market.
Steve, let me just kind of I mean, look, we have investment grade, which is up about 14% right now. You have high yield, which is up 12.5% this year. This is a great year for fixed income. Treasuries, are up very, very, much as well. A lot of that is because the Fed had this mid-cycle reset and pushed rates down, which is great, and I think it was appropriate, and that's totally fine. What about next year? You mentioned financial conditions earlier and what the Fed's reaction function is. What if, for example, we don't just get a 20, 25 basis point move higher in yields? What if it's closer to a 50 basis point move higher in yields? And that unravels a lot of what the Fed has done this year in terms of easing financial conditions. Yes, the bond market, we're big boys, we can take it, but I think a lot of passive investing that's in the markets right now are going to be very, very upset and disappointed. And given the fact that equities and fixed income have become very highly correlated, if we remember back to this time last year, the Fed was very, very nervous when the equity market started to fall. And I would argue that if interest rates move high enough, that would cause that domino effect to actually start to move. So I think within a band, if rates go up 20, 25, 30 basis points, no big deal. We can handle that. If the number's more like 50,